I think the market's already pricing in the rate cuts to a certain extent.
I don't think the Fed's going to move this month. I think that they may send a signal to help people begin to ground their expectations.
They want to send a consistent message to markets that policy is consistently moving in the easing direction.
I don't think we're in a situation where we're going to be seeing a pivot, unfortunately, which I think is what the market is probably been broadly expecting.
We've taken the punch bowl away and markets haven't fully adjusted.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
In many ways, the week begins right now. Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500 pulling back just slightly. Later on today, big tech reports. Bramo, Microsoft and Google after the bell.
This is really the kickoff of the real earnings season, I should say. The earnings season that accounts for the vast majority of the gains that we've seen so far this year in markets. And a lot of people are coming out and saying, because this market is so disproportionately hinged to 7 companies, so too will the performance be to the earnings of said firms.
Let's talk about expectations and year-to-date gains last year, not just on the S&P 500, but on some of these single names. Microsoft up 57%, Google up 58%. Just how high is the bar later on this afternoon?
I've read mixed things. Some people are saying the bar's already been lowered, particularly for Google and particularly for Apple. Other people saying that they're high expectations just because they expect them to keep going. I think it depends on which company you're talking about. There is some sort of fission within here. There's NVIDIA, where everyone expects to come out, beat, and then some, and basically blow out of the water every kind of expectation. And then you have the likes of Apple, where people just are hoping that they hang in tight. It's going to be unclear. I'm curious to see how people take some of the projections.
Likewise, we'll talk about US exceptionalism a little bit later on today. Speaking of that, in Europe, an upside surprise is stagnation on GDP. You notice that? We're talking about how high the bar is for US equities. How low is the bar for Europe right now?
Did you see the fact that Italy and Spain were the outperformers? To me, this is sort of, again, the reversal of fate of the peripheral region of the Eurozone, really outperforming Germany, which is the sick dog of Europe, and continues to be in contraction as expected, and yet still maybe avoiding some sort of recession. And this is a call for some sort of victory.
The euro, 108.39 on stagnation in Europe. Surprise yesterday, crude lower by 1.6%. Just to see that AMH yesterday, crude closing at 76.78 on WTI after the tension over the weekend.
Well, one thing Amrita Sen said to Alex Steele at this oil conference today was the fact that the supply is still there, just how it's getting to the destination has changed because of what's going on in the Red Sea and the Gulf of Aden. The issue will be if supply is really hit. And you have to remember, the backbone of supply right now is the United States of America. Still
trying to figure out America's response to the events over the weekend, still calibrating that decision. What's your view on what we've been told over the last 24 hours?
We have reporting that the retaliation is going to be much bigger than we've seen from the United States, given the fact that we have seen Iranian proxies hit U.S. bases in Iraq and Syria some 160 times. So this will be much tougher. The question is, of course, when the U.S. respond, how that response will be and how fierce. Norm Rule said it yesterday. The Biden administration is going to be walking a very tight rope when it comes to this, because they have made it very loud and clear. They do not want an escalation in the region, but they have to respond fiercely to this because 3 Americans are dead.
I'm just struck by what Tony Blinken said yesterday. I know you picked up on this also, saying that I would argue that we've not seen a situation as dangerous as the one we're facing now across the region since at least 1973. How do you calibrate a tinderbox with the necessity to respond?
Compare and contrast what they were saying back in September. Annmarie, do the compare and contrast. What they were thinking about the region only 4 or 5 months ago compared to where they see it at the moment.
September 29th, 2023, Jake Sullivan, speaking at the Atlantic Council, said the Middle East has never been quieter in decades. We have not seen it. To be fair, he likely didn't live through the 1970s as an adult in a policymaker form. But then Blinken yesterday saying it's actually the dangerous we've seen. Just in exactly 4 months' time, this administration has changed how it views the region.
It's a massive change. $77 on crude right now. WTI 76.95. Quick check of the price action for you on equities as well, not just on crude. Equity futures on the S&P 500 pulling back just a touch. We're down by 0.1%. In the bond market, Bramo victory lap a little bit later this morning. Yields lower by a single basis point, 4.06% on a 10-year. Treasury refunding shaking up this market yesterday.
It was just even the projections, right? We get the full kahuna on Wednesday, but they came out. And to me, the fact that they asked for $760 billion of net borrowing this year, below the $816 billion, ignited a rally. So again, how much is this because tax receipts are going to come in bigger?
True.
And how much are people going to say this is a bit of political maneuvering to give a little bit of support to a bond market that may have other issues later this year?
The Treasury's up, yields lower. That's the story of the past 24 hours. The story of the next 60 minutes. Brian Levitt of Invesco, head of big tech earnings. He's joining us shortly. Then later, John Lieber of Eurasia Group on heightened tensions in the Middle East. Constant Hunter of macro policy perspectives on the Fed's path forward as the two-day meeting begins for the Federal Reserve down in Washington, D.C. We begin with our top story. The equity market at all-time highs going into mega-cap tech earnings. Brian Levitt of Invesco writing this. Naysayers warned of economic hurricanes. 5 years of unemployment above 5% and the worst earnings recession since 2008. Fast forward 2 years, thanks to quickly fading inflation, a 26% advance in 2023, and we're now celebrating the S&P 500 index hitting a new record. Brian Levitt joins us around the table. Morning, Brian.
Good morning.
Brian, you said it to us. I remember the conversation. Lisa does as well. You looked down the camera and you said to us, I'm a FOMO guy. And I think we all laughed. Are you still a FOMO guy?
I am still a FOMO guy. I mean, I want to be exposed to equities in an environment after the peak in inflation, after the end of tightening, after the peak in interest rates. It's not to say that every day or every week is going to be glorious or I'm going to be missing out every day or every week, but we're in an environment where over the next few years markets should perform well. That's typically the pattern post-peak inflation and peak tightening.
Let's define FOMO in 2024. FOMO a couple years ago was GameStop and AMC. Right now, it's NVIDIA, it's Google, it's Microsoft. You basically lean into big tech and lean out of small cap?
Well, here's the challenge. So when you do what I do for a living, you're asked to write outlooks in September and October, and the story of 2024 was supposed to be, all right, interest rates are going to come down as we start to price in rate cuts. That normalization of the yield curve will lead to some small cap, mid cap outperformance. You got a 20% rally in small caps in 2 months. Right? So I wish it had played out over a longer period of time. What we're in now is an environment where the economy is hanging in but pointing towards below trend growth, and that still in the short term favors the more higher quality, larger cap stocks, and that's what's been playing out this year. What we look forward to is the normalization of the yield curve and a broader market rally.
People who are paid to have angst have put out lots of reports recently talking about the tech bubble of 2000 and raising questions about whether we're similarly concentrated. I know JP Morgan among them. Do you adhere to that, this idea that we could be hinged to some sort of massive disappointment and downdraft if one of these tech earnings disappoints?
Maybe in the short term, but I don't think about this like I think of we're not partying like it's 1999. I mean, if you look at a lot of those names were trading at either valuations you couldn't calculate because the earnings weren't there or extreme valuations. This is not the same picture. In many cases, the Magnificent Seven or many of the Magnificent Seven are actually delivering on the promise. So yeah, valuations might be a little bit extended, but these are also the companies that are growing far beyond the broad market and far beyond the economy. What I'm looking forward to, given average valuations and the other 490 names, is and international markets, can we see this broaden out? It started to in November and December because of expectations of a normalized yield curve. We're backing off of it a little bit because maybe we don't get 6 cuts this year. But over the next couple of years, we should expect that normalization of the yield curve and finally getting out of this COVID cycle, this COVID environment. So that's what I would, if I have FOMO, Jonathan, It would be in the cyclicals, the small cap, the value, international over the next couple of years.
Can we just sit on the index just a little while longer? It makes people nervous when they see all-time highs. You've written about why they shouldn't be nervous at record highs. Why shouldn't people be nervous?
Well, I think we've had 1,186 new highs in the S&P 500 since 1957. So that is once every 2 weeks. So you should expect a new high every fortnight. And there's nothing, I've always used the line, only small minds are impressed by large numbers. Like, let's not be impressed by this. The averages aren't mean reverting.
I think that's personal.
I'm insulting everyone there.
No, I'm kidding.
The averages aren't mean reverting. If you think the world is going to be better for most of us and for the 500 largest businesses in America, then you should expect many new highs over the course of your life.
Well, let's talk about the world. Which world? Are we talking about the US economy? Are we talking about Europe as well? China too? China's struggling. Europe, we talked about Europe. Bit snarky, I know, but an upside surprise for the continent at the moment is stagnation.
It is.
What does that tell you about how challenged things might be for multinationals?
Well, it's interesting. I mean, if you think about it from where those countries are relative to trend and where they're likely heading based on their leading indicators, you look at Europe, you look at China, things may actually be improving a little bit, albeit off of rough levels. So, as I've always said, these markets care about better or worse, not good or bad. And so what you're seeing in the U.S. is, and what you should expect to see, is a little bit of a slowdown. And so the slowdown favors, these top-heavy names that we've been seeing. Outside, you may actually be getting a little bit of a recovery.
But when we've seen it going on in China, especially in the Chinese stock market, why haven't we really seen any of that impact in the U.S.?
Why are we not seeing the impact of slower Chinese growth? Because the United States, we are seeing it a little bit in the broader market. You're seeing it less so in the companies that are able to grow irrespective of the macro environment globally. So for some of the companies that are more cyclically exposed to China, you're seeing it. But again, these markets in the last, at least this month, is being driven by a handful of names again.
Brian, you're going to stick with us. Let's talk about a single name. Lisa, UPS. Outward numbers. The guide for 2024, not great.
No, basically saying that they expect revenue this year to be $92 to $94.5 billion versus an estimate of $95.7 billion rounded up. Looking at weakness both domestically and abroad with respect to just in general, some of the activity. Also talking about a fourth quarter impairment charge of $84 million. Looking through the numbers, and I'll keep looking through the numbers, but I got to say, this is usually a bellwether type of stock. Is this about people shipping around goods that necessarily is independent of the economy, or does this indicate a lack of willingness to spend to the same degree?
We'll come back to that story. The early price reaction to that is the stock is down by about 4.9% in the pre-market. Equity futures more broadly negative by 0.1%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. More signs of waning demand for EVs, with Volkswagen pushing back plans to seek outside investment for its battery unit. Europe's biggest car maker is also facing doubts it can make its own batteries at scale, according to Bloomberg sources. Renault also scrapped plans to publicly list its EV business this week. Walmart is offering a new incentive for U.S. store managers. Starting in April, they'll receive an annual stock grant of as much as $20,000, with the potential to make over $400,000 if they're high performers. It's the latest effort by the retailer to attract and retain staff. Just last week, the company announced it will raise the average store manager salary 9%, from $117,000 to $128,000. Fans hoping to attend this year's Super Bowl in Las Vegas will have to fork out a record amount, with the average ticket price coming in at $9,800, the most expensive ever. That's just to attend the match between Kansas City and San Francisco. Rooms at some hotels are going for more than $1,000 a night. No word yet on whether Taylor Swift will be in attendance. That's your Bloomberg Brief. John?
I know you're tracking that, Yahara. Thank you. The latest on Taylor Swift. So $12,000 basically for the weekend, right? Once you account for flights, accommodation, throw in some food. If you're a drinker, you like gambling. This pushes what, 15K?
So at what
it's
point
ridiculous.
do we hear about the Taylor Swift inflation phenomenon once again?
Are we going to blame Taylor for this?
Yeah, everyone's going to say that. This is the Taylor Swift effect.
She might not even show up.
It doesn't matter. How much is she the responsible for a 70% increase?
She's the reason we've got to pay these high ticket prices.
Exactly.
Yes.
There we go.
According to Bramo.
No.
Up next on the programme,
Just say.
Big Tech taking centre stage.
I do think that fundamentally the strengths of these companies is still going to be pretty robust. Obviously, cloud AI is going to be the thing that's moving the dial.
That's coming up next on the programme, live from New York City this morning. Good morning. You're watching Bloomberg Surveillance. Live from New York City this morning. Good morning. Equities pulling back just a touch on the S&P 500. We're negative here by 0.1%. Stock to watch this morning. Lisa, UPS in a pre-market down hard.
And really, I'm looking through it, and it's both a volume story and profits per package, which is not really encouraging when it comes to margin pressures. U.S. package revenue was down 7.3% year over year, came in almost $1 billion or $500 million below the expectation. International package revenue, kind of the same, down 7% year over year. What I thought was interesting was that the revenue per package came in at $13.11 versus an estimate of $13.30. Again, not massive, but are we seeing both people not wanting to ship things around, not wanting to pay the extra cost for premium, and basically having to take a hit as you pay higher costs to some of your workers and to all of the other supply chain issues? How much is this a bellwether type of name?
It's a miss for the outlook. The stock is down by a little more than 4%. To Lisa's point on UPS, is that more important to the economy than maybe the tech numbers we get a little bit later? In about 15 minutes' time, we should get numbers from General Motors, so look out for that as well. Under surveillance this morning, big tech taking centre stage.
I do think that fundamentally the strengths of these companies is still going to be pretty robust. We know that obviously cloud AI is going to be the thing that's moving the dial. But what is kind of an unknown at the moment is the rate at which corporations are going to be reopening their purse strings, and that obviously has huge implications for those cloud players.
Microsoft, Google reporting earnings later today. Apple, Meta, Amazon due out Thursday. 5 names, a combined market value exceeding $10 billion. Anurag Rana, senior technology analyst for Bloomberg Intelligence, joins us now. Anurag, big afternoon coming up a little bit later, then again on Thursday. What are you and the team focused on later on today?
I think the biggest thing is the contribution of AI to Microsoft workloads. I think that is the single biggest thing we're going to focus on is how much is cloud getting a push because of that? And that remains the only thing I think people are focused on, because for the last 2 years, we have seen cost rationalization, people not spending as much on cloud resources. And I think this is the year we're going to see a rebound.
So where do you think is going to be the winning sort of recipe, at Microsoft or at Google?
I think Microsoft is a little bit ahead in terms of cloud performance only because of their relationship with OpenAI. But having said that, Google has a lot of intellectual capital behind them. They're really good in search, and I think in the long run, they should see the benefit for their cloud business also.
We were talking about this yesterday, and I got some feedback about Binging. I am curious, though, how much we end up seeing Microsoft gain traction with some of their artificial intelligence to ChatGPT around the Bing versus the Google.
See, in the long run, I think Google will still dominate. I think there is going to be a lot of noise and fluctuations in the midterm. I do not think it's going to, have that big of an impact. But at the same time, I think Google needs to come out and show that they can have a product that's very similar to ChatGPT, and it works, pretty much the same.
Anurag, can we talk about a product coming out of Microsoft? I keep hearing about this Copilot software. Anurag, what is that? How hopeful should we be?
It's pretty much you take any software that you have, whether it's your Office or whether, if you're writing code, GitHub. This particular product helps you increase your productivity. So if you have, for example, a GitHub Copilot and you're starting to write code, it will help you write code along with yourself. It's like a ChatGPT, but for that particular product. And I think that is how Microsoft is looking at monetizing a lot of its products. It is the first one in the market to go out with a lot of these, you could say, add-ons because of their relationship with OpenAI. And we're seeing other companies follow. ServiceNow talked about their product. I think Adobe is one of the ones that have done a really good job of creating their Copilot. So across the entire software ecosystem, you're going to see Copilot show up, not just this year, but, for the next several years.
Anurag, I just wanted to finish on the politics, if we can, the geopolitics specifically. Quite clearly, some of these companies that you've identified are surfing this AI wave. The cloud business is absolutely exploding all over again. Do you think that we do start to see this polarization between the companies that can serve companies over in, say, China and ones that can't?
Yeah, I think it's going to be more restrictions on the cloud players to, work with companies in China. Now, the fallback of that it's not going to be on the likes of Amazon or Microsoft because they don't generate that much money from China. But the bigger problem could be that, in the retaliation, if they go after Apple, that's, I think, bad news for Apple in the long run because they pretty much make most of their products there in China.
Interesting. Anurag Rana. Anurag, thank you, sir, of Bloomberg Intelligence. Those earnings coming up a little bit later on this afternoon. Apple, Microsoft on deck, and then the rest of them Amazon, Meta, Apple on Thursday.
I'm wondering also how much sort of quiet attention AMD is going to get, because a lot of people are saying that they should be included in the Magnificent Seven. They should be the Magnificent Eight, including AMD, or else boot out one of them. I just think that it might be interesting, especially in light of the chip focus and how much they're really accelerating that production.
Is that the pitch coming from AMD? Just to be clear here.
No, actually, it's not. It's a couple investors, including one who is a seed investor of Facebook.
Brian Levitt of Invesco joining us around the table. Brian, let's build on some of this. The geopolitics. How does that shape your view of some of these multinationals right now?
I try and look beyond the geopolitics to the best of my ability. I mean, I tend to ask myself two primary questions. One, is it going to affect the trajectory of the U.S. economy? And two, is it going to change what the Federal Reserve is going to do? And as long as these events remain relatively regionalized, then the answers to those questions are generally no. And so far, the market has looked past it. If they get broader, then it may be a different answer. We had talked earlier, I had heard 1973 mentioned. 1973 is a scary thing to think about because the markets were down like 50, 60%. You didn't recover for a long time. I think there's some critical differences between now and 73. One being the U.S. being a primary driver of supply in the oil market, and two, the Federal Reserve having significantly more credibility at this point than it did back then.
But outside the oil market, the Red Sea is really used for also consumer goods.
It is.
So isn't that a concern when you look at inflation, the prospect for potentially bottom lines having to have an impact?
Yeah, I mean, so you've got 15% of goods estimated that's going through the Red Sea, 12% of oil. So it's not ideal. Right, it's happening at a time that's not ideal. But to me, the critical difference that investors should think about is between now and 2021, 2022, when we did get significant inflation, and what was driving that. Back then, people had money in their pockets, and workers had just slashed a bunch of inventory and a bunch of workers. And that's really what led to the 9% inflation. So today we're dealing with what's going on in the Red Sea at a time that's, let's call it inopportune, but businesses have inventory, businesses have workers. So it's a very different story than we were looking at a couple of years ago.
How much is not paying attention to this just basically conditioning of markets? I go back to what Scott Shelton said, of United ICAP, saying it's been one of the more toxic trades for the last 2 years. Every time you buy, because of geopolitics, you lose money. And that's basically been the story. How much are you concerned that there isn't the same risk premium that might be baked into markets that some people say are priced to perfection, just based on the fact that you do have the potential for a flare-up that we cannot foresee?
Well, look, I mean, we always seem to have these potentials for flare-ups. I mean, we can go back in history, even recent history, Syrian civil war, when the Russians initially went into Crimea, even thinking back to U.S. troops in Iraq and Afghanistan. I mean, if you look, typically you draw down early and then over the next period come out of it. So the markets have become preconditioned. What I would say to investors is don't make it your base case in your portfolio that the world is going to implode, because history tells us that that's a losing proposition. If you want to hedge, think about, exposure to gold or, commodities. You don't need significant, 5-10% exposure can help provide some insurance in your portfolio.
Brian, let's finish on one single name. Lisa went through the earnings from UPS. The stock is down by 4.65%. Yeah. We'll get into the details as the show progresses, but I think it presents an obvious question. Do I want exposure to these big secular themes, AI, or do I want exposure to the cyclical names?
I think over the intermediate term time period, which I would define as beyond 3 to 6 months, you're going to want more exposure to the cyclical names. What we're challenged with right now, and everybody has to remember this, the Federal Reserve wanted to slow down this economy. We needed to slow down this economy. We're seeing the lagged effects of all of it, and so far we've been generally stable, but this economy will slow. Now, the question is soft landing, hard landing. Doesn't seem to be enough excess, enough leverage to have a hard landing. But in the near term, this is going to be a market that's going to focus on a slowdown. The reason why I say beyond 3 to 6 months is because as we come through that slowdown and normalize the yield curve, that's when you're going to want more exposure to cyclical names.
Brian, it's good to see you.
You
Great
too.
to catch up. Thank you, buddy. Brian Levitt there of Invesco. UPS down by something like 4% in the pre-market. Earnings from GM coming up shortly. Up next on the programme, the US weighing its response to the deadly drone attack in Jordan. That conversation coming up next with John Lieber of Eurasia Group. So for many market participants, the week does indeed begin today. The two-day meeting beginning for the Federal Reserve down in Washington, D.C. a little bit later this morning. Then this afternoon, earnings from Microsoft and Alphabet, or Google, as you might say. Equity futures on the S&P 500 pulling back just a touch with negative 0.1%. On the Nasdaq, we're down by 0.06. A heavy weighting of these benchmarks goes to big tech. 5 names, $10 trillion of market cap coming this afternoon and Thursday as well. We've had numbers from UPS, the outlook disappointed, at least the numbers from GM just dropping across the Bloomberg.
Yeah, and actually beating expectations, expecting adjusted earnings per share for 2024 of $8.50 to $9.50 versus an estimate of $7.70. Just going through the numbers here, they do expect to cut expenses by $1 billion. I am curious about exactly where they do. They expect industry sales of about 16 million units. But just going through this, it looks like North America did outperform. I just want to point out, this comes at a time when it's not just North American auto manufacturers that are experiencing some issues. BYD, the Chinese car manufacturer, overnight actually saw disappointing earnings as a result of profit margin contraction because of their competitive advantage. We'll keep going through these numbers, but to me, the idea that they actually beat highlights the fact that they are maneuvering, albeit with cost cuts that we hope to hear more about.
So UPS dropped about 4% after earnings. GM's up about 4% after these results. Positive in the pre-market now by more than 5%. Lisa, good news is they've got a better story to tell this morning, because for the broader environment, as you just suggested, not great right now. We need to talk about EVs with Mary Barra a little bit later on today, the GM chair and CEO. The news over the last few weeks, Hertz dumping 20,000 EVs, Ford cutting production of the F-150 Lightning. Hasn't been great, has it?
No, and basically there's been a retrenchment in expectations. We heard that from Ford and we heard that from General Motors, and this expectation that, yes, there will be that adoption, but it will be slower. Just looking through some of these numbers, the net profits here are better than expected. And how much of this really is hinged to the lust for big trucks and the fact that people don't really haven't made that transition yet. The net income for 2024, $9.8 billion to $11.2 billion versus the estimate of $9.17 billion. Really coming in pretty strong.
Stock is positive by a little more than 4% in early trading. A little bit later on today, around 10 a.m. Eastern time. Don't miss this conversation with Mary Barra, the General Motors chair and CEO, live on Bloomberg Television. Under surveillance this morning, Iran urging diplomacy as tensions rise following the deadly drone attack on a US base in Jordan over the weekend. The country's foreign minister continuing to deny involvement in the attack, which killed 3 service members and injured dozens more. Political pressure is building on President Biden to respond. National Security Council coordinator John Kirby telling reporters yesterday the president is weighing the options before him. AMH, what are those options?
Well, this is the big question. What are the options the United States is going to do? We know from our reporting that it is likely it is going to be a more forceful response than we have seen the U.S. take, given the fact that U.S. troops have been hit on the bases 160 times that we've seen these Iranian proxies target U.S. troops. So it'll be more forceful than that. But, and every administration official you talk to, there is a but. They continuously say they do not want to invoke a wider regional conflict. So it's not going to go as far as I think maybe some, especially Republicans, want.
A question we can ask this morning. To prevent a war, do you have to show a willingness to engage in one?
Show that you're willing to actually go on the massive attack. This is what the Trump administration actually did when it came to going after Iran and Qasem Soleimani. They did an attack that the Iranians were really, frankly, freaked out about. They did some retaliatory measures in Iraq, but then on back channels, they went through a number of interlocutors and said, we are done. We do not want more bloodshed in the region. And then that was it. Remember, then COVID hit, and that story quickly went away. And that was why. We'll
throw that question to John Lieber of Eurasia Group in just a moment. Wanted to turn to this story as well. Lisa, you were all over this just yesterday. The US Treasury cutting its quarterly borrowing estimate. The estimate now sitting at $760 billion. That's down from a previous prediction of $816. The announcement helping stoke Iranian stocks and bonds. The Treasury saying the estimate was reduced thanks to higher net inflows and more cash on hand than previously expected.
And just remember that really what ignited the incredibly rally, or at least turbocharged it last November, was that Treasury refunding announcement back then that really concentrated more of the borrowing in T-bills. Look, a lot of people are going to be talking about the political aspects of this. And Peter Bukvar of Obliquely Financial came out and said there is also political maneuvering on the part of Janet Yellen in wanting not to spook the Treasury market. We'll hear in the coming days, Wednesday, about just how the issuance is going to come out. But the truth of the matter is, later this year, The U.S. is expecting yields to be lower because the Fed's probably going to be cutting. So why not wait until then to actually increase some of your issuance if the yields are better? Honestly, it's pretty savvy. You gotta hand it to her. She understands the markets.
They're managing it well.
Yeah.
Understands other things as well, based on what I heard yesterday afternoon in a podcast that she did over in Chicago. Did you see that?
Yeah, I was hearing about it.
She did a podcast with NPR, and she was asked a number of questions. One, she plays Candy Crush. And she loves Brick Breaker when she had a BlackBerry, but also she prepares for everything. The Treasury Secretary said the first time she smoked weed, she actually prepared, but then that gave her an addiction to cigarettes.
What was it, 2 or 3 packs a week?
Yeah.
Is that right? It's amazing. It was nice to see Janet Yellen show a little bit of personality.
Totally different
on
side
this
of her.
podcast.
Maybe-
Not that sort of robotic outlook on the economy.
Was
very,
it
very different.
In an In-N-Out burger, as she
loves
ate her
burgers.
fries.
Super
Yeah,
chill,
exactly.
apparently. Let's see how chilled you are about this story. Elon Musk announcing the first human patient has received a brain implant from Neuralink. The startup hopes to one day allow humans to control computers with their minds. Posting on X, Musk saying, quote, the first human received an implant from Neuralink yesterday and is recovering well. Initial results show promising neuron spike detection. Last year, Neuralink said it expects to perform 11 surgeries in 2024. Bramo, thoughts?
I think it sounds so good. I think we should do it. No, look, I mean, honestly, this isn't necessarily going to be the future for our computer use anytime soon. This is sort of an experiment, and kudos to him for thinking brightly. I personally would not have a Neuralink in my head, but also the people who are doing it have problems with their limbs. And so it's actually, it's geared toward people who actually might get some real use in a material way.
For people who are paralyzed, and this could be incredibly optimistic for their lives. But the fact that Elon Musk also talks about one day helping merge humans with artificial intelligence, that's when that's a little bit unnerving. I know you must be nervous because I know you don't like AI.
Yeah, stage 2 concerns me. Stage 1 is super promising. I think we're all on the same page about that.
Yeah, look, I think down the line, as somebody who does enjoy science fiction occasionally, it's nice to have big dreams and see how it plays out. Whether any of us wants to become
telepathy,
a robot right now, not clear. But later on, when the bones hurt, let's go.
I'm not ready for that just now. That's the latest on Elon Musk and Neuralink. Let's turn back to the latest in the Middle East. Iran continuing to deny involvement in this weekend's deadly attack on US troops in Jordan. The country's foreign minister saying active diplomacy is underway, writing on X, quote, the White House knows very well the way to end the war. The current crisis in the region is political. John Lieber, Managing Director in the United States, the Eurasia Group, and former policy advisor to Senator Mitch McConnell, joins us now for more. John, wonderful to catch up with you, sir. Let's start here. Have you developed a base case as to how you think the US will respond to the attack over the weekend?
So the U.S. has to respond here. They can't allow the deaths of 3 U.S. troops to go unanswered. And that's both a problem for the Biden administration in foreign policy in the Middle East, but it's also a pretty big political problem for him in the United States. And the key question we're focused on is whether or not that retaliation and escalation starts to touch the oil markets. And the way it would do that is by taking Iranian barrels of oil off the market, which we don't think is likely. So what is more likely is targeted strikes against these militia groups that are operating out of Syria and Iraq to degrade their capabilities to continue attack against U.S. forces, which are spread across the region. This will probably come in the coming days or perhaps even weeks. It's going to have to be a big public show by the Biden administration to make a difference. But Biden administration can't just sit back here. Obviously they risk the threat of stoking a broader regional war with Iran, but nobody wants that. Iran doesn't want that. The U.S. does not want that. And, the way that the militia groups work with the Iranian government, sometimes they're funded, sometimes they're not, sometimes they've had military support. But attacking the militia groups should be enough to satisfy the political desire in the U.S. to get back. And it's up to the Iranians and the groups then at that point how this escalates.
But John, aren't they already doing that, degrading the capabilities of these Iranian proxies? What will be different than this? Will just be that it'll come in stages and we'll see more of them?
Yes, I think you're going to get a more forceful response. You look at the escalatory ladder that the U.S. has, which is how we think about this, and striking these groups is the first step in that escalatory ladder, figuring out ways to cut off their funding and their support is where the U.S. is going to focus right now. But there's a lot more they can do. They know where they're operating out of, and they can attack them more directly. And part of the story here is that the U.S. The group slipped in this drone behind another a U.S. drone that was landing, according to some Wall Street Journal reporting. So part of this is going to be defensive as well, to make sure that future attacks don't threaten the lives of U.S. service members, but there has to be some kind of visible response, kinetic force response against these groups in the region.
The Biden administration has gone out of its way to make it clear that they do not want a showdown with Iran. So is the message, though, to Iranian proxies that if they keep it at this level in terms of hits on U.S. troops, that's acceptable?
No, I mean, this is obviously, this is why they have to try to escalate. I mean, I think that in some ways the groups got a little lucky here because they were able to exploit this weakness in the U.S. defenses. There's been hundreds of these attacks over the last several weeks, and the U.S. is continuing to try to degrade, but there's more that they could do, and that's what we're looking for.
John, I was struck by Javier Blas, our columnist here at Bloomberg, writing this piece today. America is subsidizing Iran's fight against America, talking about how the sanctions have not worked and that, if anything, Iran has turbocharged its production and is making billions of dollars extra each year as they do amp up some of their production. Do you think that sanctions have just completely failed and that right now, in effect, some of these are allowing Iran to keep financing some of these fringe groups?
I wouldn't say the sanctions have failed. I would say the Biden administration has made a deliberate choice to allow the Iranian oil barrels to continue to flow primarily to Chinese purchasers because of the fact that they are concerned about the overall effect on global gas prices. And they're attempting right now this thaw in relations with China overall that has limited their option set for how to go after these Iranian barrels without going after Chinese entities. That's probably the next step on this escalatory ladder if the U.S. decides to crack down on the sanctions that are allowing the Iranians to sell barrels of oil. Now, the U.S. is the world's biggest producer of oil right now. There's been a boom in production here, which is going to help the Biden administration take these steps as they think appropriate to squeeze the Iranians.
Is the effort to keep oil prices low in the U.S. harming the national security of the country if you are having this issue where it's basically increasing profits to Iran and potentially severing certain relationships with Europe with respect to the LNG bans or the pause that we've seen recently?
I mean, the LNG bans are a different story. That's more about domestic climate politics. But in terms of national security, I mean, Iran is a growing threat in the Middle East. It's a growing threat to U.S. interests there. For a while, the U.S. could afford to look the other way as the Iranians continue to sell these barrels. But now it seems like that calculus is shifting a little bit. And this is going to be a delicate balance for the Biden administration to get it right.
John, I think we all can say the same thing. None of us want to see a war develop here between the United States and Iran. I just want to get your final thoughts on how you think the administration should approach this. They always caveat everything they say, and we've seen it repeatedly over the last 24 hours. We do not want a war with Iran. After the attacks of the weekend, you have to ask yourself a different question. Does Iran want a conflict with the United States? And how would a future president, if it's different to Joe Biden in the next 12 months, deal with this perhaps in a different way? To prevent a war, do you have to show some unpredictability here? Show at least a willingness to engage in one if you have to?
So it's not clear how much control Iran has over these proxy groups that are launching these attacks. They could probably get them to stop. And, the Trump administration's attitude was, we're going to try to escalate in Iran in order to get them to stop by killing Soleimani. That seemed pretty effective. Yes, of course, as you all pointed out, COVID didn't intervene, but the Iranians didn't retaliate in any meaningful way after that incident. So I think it is an important question for U.S. foreign policy is how aggressive and provocative can the U.S. be without forcing an escalation backwards from Iran. The Biden administration has been much more cautious than the Trump administration has been. They think that they're worried about, this escalatory cycle. But I think the Trump administration, based on the action of killing Soleimani, gives us some reason to believe that an aggressive attack in Iran could be a way of actually de-escalating the situation.
Interesting. John, appreciate your input. As always, you're one of the best. John Lieber there of Eurasia Group. Looking at Crude right now, Brent, WTI almost totally unchanged, 76.75 on WTI crude. Let's get you an update on some of the stories elsewhere this morning. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. UPS shares are falling in pre-market trading after lowering its revenue estimates for 2024. The company also reported a bigger than expected revenue decline in the fourth quarter, with the CEO calling 2023 a, quote, unique and difficult year. 5 of the so-called Magnificent 7 are set to report this week, with Microsoft and Alphabet on deck after today's closing bell. Investors will be looking for expansion in AI and earnings to justify higher valuations and Microsoft's over $3 trillion market cap. AMD also reports this afternoon as it looks to compete in the chip space, especially against NVIDIA in the race to power artificial intelligence. Apple, Meta, Amazon report on Thursday. The PGA Tour is reportedly close to receiving an historic investment from billionaire sports team owners. Steve Cohen and Mark Lasry are among the group of investors set to inject about $3 billion into the league. The deal may not initially include Saudi-backed LIV Golf, with talks still fluid on how to include the rival organization. And that's your Bloomberg Brief. John?
Yahara, thank you. Coming up next on the program, the Fed's two-day meeting begins.
The next few months are going to really determine whether that soft landing story becomes the base case or whether we move back into that recessionary scenario markets. And I think you're going to see the Fed grapple with that at the next meeting.
Live from New York City, a preview of the next meeting concluding tomorrow. That preview coming up next. This is Bloomberg. Live from New York City. Here's a snapshot of the markets right now on the S&P 500 shaping up as follows. Equities pulling back by 0.13%. Yields lower by a single basis point, 4.06%. Big 24 hours ahead. Under surveillance this morning, the Fed's two-day meeting begins.
Are going to really determine whether that soft landing story becomes the base case or whether we move back into that recessionary scenario markets. And I think you're going to see the Fed grapple with that at the next meeting. They're going to open the door for rate cuts, but also be aware that there are still risks to the outlook. I think they want to send a consistent message to markets that if policy is going to start moving in an easing direction, that's consistently moving in an easing direction.
That decision is coming tomorrow. Investors looking for clues on the next move and whether we get a rate cut in March. Democratic senators would like one right now. Writing in a letter to Chairman Powell, we urge you to consider the effects of your interest rate decisions on the housing market and to reverse the troubling rate hikes that have put affordable housing out of reach for too many. Constance Hunter, Senior Advisor at Macro Policy Perspectives, joins us now. Constance, we'll get into the actual preview of the Federal Reserve in a moment. How unhelpful is it to get that kind of letter to Chairman Powell at a time when he's probably going to start talking about reducing interest rates anyway?
Well, precisely. And look, Powell has threaded a very fine needle through his entire tenure to be apolitical, to do the Fed's job of just looking at the economics and not having it be a political decision, and to defend the independence of the Federal Reserve. And it just undermines that work that he's done. Maybe undermines is too strong, but it gives fuel to the fire for those who want to make an argument that the Fed is making political decisions when they're absolutely not.
What do you expect from this meeting? A lot of people saying it's going to be a snoozer with some adjustments around some of the language to allow for a hike, maybe in March, a cut, maybe in March if they see it necessary, but more likely in May.
Well, given the bond market volatility we've had with every little second tiny minutia of data and information, I don't think that it's going to be a snoozer. And what we expect him to do is to lay the ground for why a March rate cut makes sense, right? We have PCE on a 6-month annualized basis already at their target, core PCE already at their target on a 6-month annualized basis. They have already laid the ground for looking at balanced risks. And as we know, the job market is softening. We're seeing a narrowing in the sectors that are hiring. And our proprietary research suggests for the first time that layoffs are coming at a higher level than hiring. So we do web scraping of earnings reports. And of course, we only have 12% of companies have reported so far. But we see a big shift in our data that we're collecting.
And this is actually really important, especially given some of the commentary that we've heard even from Fed officials recently. Michael Darda kind of echoing some of your concerns. Roth MKM wrote recently, the last time credit markets rallied this dramatically 18 months after the yield curve inverted was in the summer of 2007. Since the consensus has coalesced around an incredibly rosy scenario of no recession, no inflation, no Fed policy errors, and a double-digit breakout in earnings, it makes sense to consider alternative scenarios. So from your perspective, Constance, what is the alternative scenario that's most likely?
So, I would say there's actually three scenarios, right? There's the no landing, which of course would be the ideal situation where the Fed cuts perfectly presciently. We manage to avoid some months of negative job growth, and the economy kind of hums along. Then there's the soft landing, which of course is still a landing. Let's not forget, right? So we would be looking at sort of near zero GDP growth for a quarter or two, and then we'd be able to progress. And then, of course, there's the hard landing, which would be a recession. And I would actually say the risks are fairly evenly balanced across those three. There are so many unknowns. I mean, obviously what's happening in the Middle East, how that's going to impact oil prices, how that's going to impact shipping supply. There's always that possibility, right, that you're going to have a recession. But I do think the soft landing scenario is the most likely. Given the fact that the Fed is sort of indicating that they're willing to move on interest rates in a timely fashion.
Constance, I know you're across the markets as well, so let's do some of that too. Equities at all-time highs, credit spreads really tight. We've had a ton of issuance for January. Lisa can go through the numbers. We're talking about a massive month for credit issuance for the month of January. Constance, when you look at those easing financial conditions, do you see that delaying weakness in the economy? Is that sufficient?
That's an excellent question. I think it's somewhat unclear. There are pockets of the economy where we know there's significant stress, right? So Class B and C office is under significant stress. We see this surge that we've had over the last several years in apartment building that's pushing down rent prices. Overall, a good thing for prices and overall a good thing for the consumer, but could cause some stress in the residential housing market. And of course, the layoffs are coming, we think. And so, once you start having negative job prints, if we get to that point, that can spiral into some pretty negative results for the economy. So I think it's a very, very tight rope that the Fed is walking, and that equities are walking, quite honestly. And so while I'm overall bullish because I think we're having a huge productivity surge, productivity surges are unevenly distributed throughout the economy, and there could very well be significant pockets of disturbance that ripple out and cause a wider problem.
So you're looking for that first move in March, that first rate cut. Constance, with that in mind, when you hear people say that Chairman Powell tomorrow will be non-committal, how non-committal can he be, given the Federal Reserve likes to do this in a predictive fashion?
Yeah, I mean, look, he wants to keep all options open because, of course, there's always surprises. But I think he also wants to lay the ground so the market isn't completely shocked if the Fed moves in March as we expect. And let's not forget, one of the things that he's mentioned is that policy is very restrictive, right? We've seen that from Williams. We've seen that from other Fed speakers. And so do they need to be very restrictive? Can they move to merely moderately restrictive, still putting downward pressure on prices, but also easing financial conditions a bit more? And I think that's the direction of travel that he's going to talk about.
Interesting. Constance, thanks for jumping in front of the camera for us this morning. Appreciate it. Going into the big one tomorrow. Constance Hunter there of Macro Policy Perspective, looking for that March rate cut, Bramo, ahead of tomorrow's meeting.
I love what you were talking about with respect to just the credit markets being wide open and how that changes some of the weakness that people are talking about. We're talking about almost $190 billion of sales of investment-grade bonds.
Huge.
Just in January, a new record. The likelihood of that crossing $200 billion, some people are saying, is pretty great. And this comes at a time when spreads have hit the lowest for that particular asset class going back to January of 2022. So you put all this together and you wonder how much that's going to actually have an effect on the overall economy ahead of whatever the Fed does or doesn't do.
We talked about whether they would need to survive until 2025 it looks like they're getting in front of 2025 already.
Thrive in 2024, right?
Right.
It seems like this isn't really an issue. I am wondering how much is for the lower-rated companies. You are seeing some of them come to market.
True.
Is this just a window? And are they seeing this opportunity before that volatility?
Taking advantage of it big time. Busy January. What was that number again?
It was $188.57 billion
Wow.
as of yesterday, but Johnny Fine at Goldman Sachs thinks it's going to hit $200 billion.
It's going higher.
Yeah.
Okay. Coming up next in the next hour, Jill Castilla, the CEO of Citizens Bank of Edmund, Nikolai Tangen, CEO of Norway's Sovereign Wealth Fund, and Emily Rowland, co-chief investment strategist at John Hancock. All of that and more from New York. This is Bloomberg.
We see inflation peaking and growth peaking.
This is probably that peak Goldilocks scenario. And really the next few months are going to really determine whether that soft landing story becomes the base case.
The probability of recession has pretty much vanished over the last couple of quarters.
And I do think that there's improving prospects for a soft landing here. That prospect, I think, has improved materially in my view.
Hard landing looks soft until it's hard. It's going to be hard, I'm sure of that. It's going to happen at the end of the year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Dom Constant of Mizuho was so bearish yesterday. It was unreal. Looking for unemployment at 6 or 7% year-end, 20 to 30% downside on the S&P 500. What a way to start your morning from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500 negative here by 0.1%. Two stocks, two stories. Earnings very, very different for UPS versus GM. UPS in early trading is down by more than 6%. Bramo GM higher by 7.5.
And it all had to do with the 2024 estimates. UPS underwhelming by pretty significant margin. How much is this because their packages are just going down, their profit margins are going down? How much is it competition with Amazon? General Motors, the opposite story, seeing additional profits in 2024. Speaking of certain cost cuts, but defying expectations of a much poorer outlook, even with all the concerns about higher labor costs, about a transition to EVs that is getting stymied, and potentially a more difficult scenario for consumers.
We'll speak to Mary Barrett a little bit later this morning. I think we still need to talk about the future for EVs given the setbacks. We talked about this in a previous hour. It's worth going over again. We've had Hertz dumping 20,000 vehicles, Ford pulling back from production of the F-150 Lightning. We had some news over in Europe, I think, on the likes of Renault and VW as well. News not good there at all.
But this also comes as people are saying it is not necessarily completely thrown out of the water, but just delayed in terms of the transition. What I want to hear from GM, how are they adjusting the mix in response to that? Is it still all trucks all the time, including gas guzzlers, because that's what people are buying? And oh yeah, if you have money, they're the ones that are buying it too, because no one wants to take out a loan for 7%.
But also dealers not only wrote a letter to President Biden saying this is not working, these EVs are sitting on a lot, but the dealers that sit on the GM advisory board, the Wall Street Journal says they're telling GM people actually want hybrids. They're transitioning slower. They want a mix to make sure that they have that range capability. So, potentially she'll have something to say about that. Maybe they're moving into hybrids.
This is kind of the interim moment for the auto industry, and I think Mary Barrett's pushed back against the idea that you need this because it distracts ultimately from the ultimate destination, which is to get to EVs. Ford seemed to have taken a very different position on this based on what we heard from Mr. Lawler maybe a few months ago.
He had a longer-term ratcheting down of expectations in terms of total deliveries of electric vehicles and manufacturing. I'm curious how much this is also coming at a time where Chinese auto manufacturers have a real upper hand. And even though they have an upper hand, they're not necessarily making the profits because they're trying to drive competition out by simply lowering their prices. This is a complicated story, and it's not quite clear exactly how it's going to be won.
Mary Barra, Chair, CEO of GM, coming up a little bit later on this morning around 10:15 Eastern Time. Let's get a snapshot of the markets for you. Equity futures on the S&P 500 negative here by 0.1%. 5 names, $10 billion of market cap, just unbelievable. We'll hear from the likes of Alphabet and Microsoft this afternoon. And then on Thursday, Bramo, it's Apple, Meta, and Amazon.
I mean, this really is sort of the make it or break it moment. A lot of people talking about how top heavy this market is. If we have ridden all of the gains so far on these particular names, how vulnerable are we to a disappointment that moves us in the opposite direction? Basically, everyone we put that question to says they're not going to disappoint, so stop even thinking that way.
Just in case we run out of time, do you want to take a look at the bond market briefly? 10-year yield down a single basis point. Big move lower yesterday. Do you want to give us the why?
I would love to.
Sure.
There was a preview of what kind of Treasury financing would be necessary this year, and it came in lower than expectations because of tax receipts and other factors that Janet Yellen was looking at. This basically is saying the sort of supply isn't going to be there to the same degree that people thought. So that means that there was a rally in the bond market.
4.06% on a 10-year, the 2-year, 4.32. Coming up this hour, Jill Castilla, the CEO of Citizens Bank of Edmond, on the outlook for regional banks. That conversation starting very shortly. Nikolai Tangen of Norge Bank Investment Management on the AI-driven surge in tech. And I have to say also, Bramo, some weakness in commercial real estate.
It was the first time in a while that they underperformed the benchmark, and it was because of the diversification, how diversification can bite when it really is the consolidation among a few names that's really the winning.
And then we'll get back to that EV story later this hour. Craig Trudeau on GM's better than estimated fourth quarter earnings. We begin with our top story this hour. Regional banks looking to bounce back from a tumultuous 2023, but risks remain.
I'm very much concerned about the small and mid-sized banks. They've got several risks happening at this point in time. They've got commercial real estate and a refinancing wall in that space and a refinancing wall in their commercial and industrial loans. And I think that this is going to cause them to have to, really take risk considerations very carefully. And I think the lending capabilities that they're going to have and the capacity that they're going to have to lend is going to be very limited.
We can get you a much more stronger story than that with Jill Castilla, the CEO of Citizens Bank of Edmond, who joins us around the table now. Good morning, Jill.
Good morning.
You've got a powerful story to tell. It is not that gloomy. Talk us through it.
It's not. I think relationship bankers that have intimate knowledge of their borrowers and that have been disciplined through these last 5-10 years are not going to see the type of weakness in the commercial real estate market that others are anticipating. I think those that have more distance from their borrowers or outside the banking system, I think that's where it has a vulnerability. Lots of regional impacts as well. So large urban centers with large multi-tenant buildings have more susceptibility to some of these this weakness and higher interest rates and potential vacancy issues than maybe smaller type of commercial real estate that may be office occupied still, but that the lender knew this borrower and was able to structure appropriately. Low LTVs, focusing on debt service coverage for the last few years. Those types of lenders are going to come out okay.
There was some real stress about 9, 10, 11 months ago in the spring of last year for the smaller banks. I think for a lot of people, they concluded that the bigger banks will get bigger and the smaller banks need to grow and consolidate. Do you have a different view on that? The reason we need more than 4,000 banks in America, why do we need that number?
Well, when we talk about smaller banks, even at the beginning of last year, small banks, truly ones like mine, were fine. We really didn't see the deposit runoff because there's a diversity of deposits. The average deposit amounts are very low. And so you weren't counting on hundreds of millions of dollars concentrated on very few depositors. And also you had more, like we have, 2/3 of our deposits are non-interest-bearing, non-maturing deposits. And so when you have that, there's not, even though you had some loss and some now competitive pressures on the interest-bearing deposits, you just didn't have those same pressures as like some of the large regional institutions. Broker deposits also increased quite a bit due to demand earlier last year, and we've seen that soften quite a bit. Again, it goes back to relationships, and I think whenever we look at having 4,000 plus banks in the United States is a great strength for us, both in having a bank in your location. If you're in rural areas, you may not have access to a bank if you have consolidation. I'm in a suburban area with over 50, 60 banks in a 100,000 person town, but there's relevancy for a small bank because we're the ones, sponsoring the football stadium and the Little League games, and we put on a big street festival to revitalize our downtown. There's social capital there that you don't find in larger institutions, and you see it even represented in TV or movies, just how important a bank can be. Consolidation yields distance, which I think also yields risk. We're seeing that as we just talked about commercial real estate and deposit potential loss. Whenever you have a tie to your bank and your banker, it lessens the risk overall, even though it may be small institutions. Systemically, it makes a difference.
Let's talk about some of those relationships, especially at a time where a lot of Fed officials are talking about anecdotes and how important they are to really understanding the economy. How much is the economy slowing? Do you get the sense that you're clients, the relationships that you have, are expressing a greater degree of concern than some of the macro data might suggest?
I really don't see that in our locality. I think regionally you do hear that. It does have an impact on small business as we have rates increasing for them, especially those that have variable rates where they're not having a big repricing or refinancing, that this is hitting them with each rate increase. And so they're starting to have that pressure. As commercial real estate has the higher need to be able to service their debt, we've seen rents go up quite a bit. So some of the small businesses, it's really been more of a struggle. And then for consumers as well, the higher cost of putting food on the table and operating a household have been really challenging.
You talked about the strength of being a smaller bank and all of these relationships and the ability to diversify in the way that you want. How vulnerable do you feel to some of the new capital rules that could come down the pike that we keep hearing about in Congress?
Yeah, the new capital rules don't directly impact me because they're targeted for larger institutions, but there will be some type of trickle down. What I'm most concerned about those new rules is whenever we have greater specificity, whenever it's that this is going to cost you more capital versus it being generally you need to have more capital, is you have unintended consequences. So then you have potentially some transactions that would occur within the banking system get moved out of the banking system and actually could have more harmful impacts to the economy and less ability for regulators to have an impact.
Do you think the proposal meets the moment then? Based on what we saw last year, what was that in your mind? Was that a failure of regulation or oversight?
You know, just as we need to hold banks accountable, I think regulators are also accountable too. We have really great regulations and we have really great decentralized regulatory structure in the United States, which is a great strength. And I think where we've seen some failures or some vulnerabilities, whenever that hasn't been executed well. So that's what I would say is that we really we have great regional examiners that are on the ground that understands the local economy, what type of risks banks are taking. And it's just important that they continue to do that. And I think changing the structure kind of can penalize and take that autonomy out, and you then aren't able to assess risk as sophisticated in such a sophisticated manner as you could do before.
What kind of proposal would you like to see? Some kind of deposit insurance reform? What would you like to see?
I think the deposit insurance is also, there's so many different tools with marketplaces to be able to exchange deposit insurance, ability to pledge collateral to deposits, that there's really, to me, there's no need to really change anything there. We have less than, we're right at 5% uninsured deposits in our organization. And when we saw organizations last year be over 90% uninsured deposits, there was no reason for that. There was plenty of tools to be able to use. And you now see banks really shifting and making sure that they don't have that exposure on an uninsured deposit or uncollateralized deposits.
Bramo, we've been talking about this, whether the regulation, the proposal at least, meets the moment of 9, 10, 11 months ago. And the message I keep receiving every single time is probably not.
Not only that, but a lot of people are saying that probably down in Washington, they're going to start to agree with this. Morgan Stanley actually started to turn bullish on U.S. banks.
Betsy
Gracick, because she didn't think that the capital rules would be as harsh as some people were expecting. So that pushback is pretty widespread, and maybe some people are already pricing in that it's not going to really get applied as initially proposed.
We'll keep this conversation going. Jill, you're going to stick with us, I'm pleased to say. Jill Castillo there. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief with Yahara Hakaz. Hey, Yahara.
Hi, John. Iran is urging diplomacy as tensions in the Middle East rise, following the death of 3 American soldiers in a drone attack over the weekend. Iran has continued to deny involvement in the attack, which the U.S. has said came from Iranian-backed militia. UPS shares are falling in pre-market trading after lowering its revenue estimates for 2024. The company's fourth quarter revenue also fell short of estimates, with the CEO calling 2023 a, quote, unique and difficult year. It comes as UPS tries to win back delivery business lost during tense union talks last summer. Meanwhile, General Motors reporting better than expected fourth quarter earnings and expecting 2024 profits to grow on improved U.S. sales. GM's expecting demand for vehicles to stay robust, in part due to optimism about a soft landing for the U.S. economy. While GM is struggling to build out its EV line, its legacy business of gas-powered vehicles continues to be a cash cow. CEO Mary Barra saying, quote, consensus is growing that the U.S. economy, the job market, and auto sales will continue to be resilient. That's your Bloomberg Brief. John?
Impressive numbers from GM this morning, that's for sure. Yahara, thank you. Up next on the programme, the AI-driven tech rally extending into 2024.
We had the big AI boom pushing through earnings for tech stocks last year. Maybe we're seeing a little bit of that enthusiasm at the start of this year.
That conversation is coming up next. We'll catch up with Norway's Sovereign Wealth Fund, the CEO, just around the corner. Live from New York City this morning. Good morning. Stocks pulling back on the S&P 500 by 0.1%. The bond market looks like this, down a single basis point, 4.06% on a US 10-year. Under surveillance this morning, the AI-driven tech rally extending into 2024.
Earnings optimism can outweigh temporarily, at least, what the impact is on higher discount rates. So we had the big AI boom pushing through earnings for tech stocks last year. Maybe we're seeing a little bit of that enthusiasm at the start of this year.
Earnings from Microsoft and Alphabet due later today. Apple, Amazon, Meta on Thursday. The Norwegian Wealth Fund raising its tech holdings on the back of the AI frenzy. CEO Nikolai Tangen saying this: despite high inflation and geopolitical turmoil, the equity market in 2023 was very strong. Technology stocks in particular performed very well. Nikolai, I'm pleased to say, joined us now for more. Nikolai, wonderful to catch up with you, sir. We've got to do two things, a range of things, but the first two, let's talk about tech, and then we'll talk about commercial real estate. For tech, you said to us recently that your broader return assumptions are lower going forward from here. Does the same apply to this particular cohort of stocks in the US?
Well, we've had a huge rally last year, and a very large proportion of the returns we had in the fund were from the top 7 companies, right? Now, if you adjust S&P for that, the return was something like 12% instead of 26%. And you kind of have to ask how long that's going to go on for. Now, I'm a diehard believer in AI and the effect it's going to have on our operations and the world generally. But in terms of valuations of the companies, that's a different question.
There is this issue of how fragile it makes the market to have such a consolidated group of stocks driving all returns. Khurram Chowdhury of JP Morgan recently warned that there was a bigger risk to the overall equity market as a result of this, saying the key takeaway is that extremely concentrated markets present a clear and present risk to equity markets in 2024. Just a very limited number of stocks were responsible for the majority of gains. Drawdowns, on the other hand, could pull equity markets down with them. Do you agree with this, or do you think that ultimately AI is the only game in town and it doesn't matter how consolidated that the entire equity valuation of the global market really is to it?
Well, for the first thing is that this has been going on for a long time, right? It's not something that's happened overnight. These large companies have become stronger and stronger. And it's natural when you talk to these platform companies that it really is a winner-takes-it-all economy. And it's amplified by AI because it's so incredibly expensive to train the models that you really have the winners becoming even bigger. So it's not a new phenomenon, and I think it will last for some time.
Winner takes all really raises this question of the purpose of diversification. And Nikolai, I'm wondering, especially if the diversification was responsible for the underperformance this year, does that mean that maybe diversification doesn't have the same benefit and you should just consolidate your bets in what you believe in?
Well, we are, given that we are a very large investor, we have to be diversified, right? So we own a bit of all the listed companies in the world. We are participating in 9,000 companies. We have big bond holdings. We got big real estate holdings. I think it's the only way to be as a big and very long-term thinking shareholder.
I saw that real estate holdings dropped more than 12%. Let's talk about that a little bit, Nikolai. Something you said to me a long time ago has always stuck with me. When you're as big as you are, it's not what you're in, it's what you choose not to be in that really counts. Does that apply to real estate going forward from here?
Well, we have a bit more than 2% of the fund in unlisted real estate. And you're right, clearly results were negative last year, but there'll be some years when it's positive. So we think could be an opportunity to look to add to some assets. If you are a long-term investor, it's part of your mix.
Would you be actively now looking then to add to real estate, Nikolai, or still too early?
It's difficult to say. We are always looking for good opportunities.
The reason I ask this, as you know, is because you've already told us that you think maybe inflation is stickier, rates stay higher for longer. When you have that kind of worldview on the macro side of things, on central banks, how does that influence your thoughts on what you need to be in and what you want to steer away from?
Well, I think that inflation could be tougher to get down than what some people think. We are seeing wage demands across the world being pretty strong. This is something that hits all the companies, and typically what we see after a round of wage increases is that the companies raise prices to offset that kind of cost pressure. So that's one of the risks we are looking at. We are looking at geopolitical risks. So I don't know, it doesn't add up to a very happy cocktail. And I think in that world, you just really need to be diversified across asset classes.
In such a geopolitical moment, how much do you find yourself picking winners in terms of regions with respect to artificial intelligence, but also with respect to just being able to beat inflation? In other words, is U.S. still the brightest place to concentrate more investment?
Well, we have nearly half the value of the fund is invested in the U.S., and we think we own tremendous American companies. Now, I lived in New York the whole of November. I met with some 30 CEOs, and wow, things are going pretty well there compared to Europe. So it feels like a good place to be with a large part of the fund.
So you'd be interested in increasing allocations to the U.S. versus Europe on the margins, understanding that you remain diversified?
Well, we have been doing that over the last year or so, but we feel pretty happy with the mix we have now.
Going forward, there's a real question around just how much returns are going to be lower and how to beat them, given the fact that the goal really is to just marginally increase returns based on the index. Where do you see the outperformance coming from other than artificial intelligence?
Well, you just have to pick the winners in all industries and all categories. You know, you basically will have winners in the luxury goods industry. You'll have winners in the cosmetics industry. You just have to have portfolio managers who really understand these sectors really, really well and pick the winners in the pharma industry and so on. And we got some great portfolio managers, and that's what they're doing all day long.
You said in January, the way to make money in the long term, you have to be contrarian. Nikolai, what's the contrarian bet for you right now?
Well, I have to say, if you want to be contrarian, you walk down the main street of Davos, AI on all the different windows. The contrarian thing now would be to underweight AI.
Are you doing that?
No, we're not doing that in a big way. But if you really want to be a contrarian, that's probably what you do, and you probably pile into property stocks.
When you talk about some of the pharmaceutical winners, how much are you betting on the whole Ozempic existence of our future?
Well, it's one of the biggest holdings we have. It's Novo Nordisk in Denmark. It now passed LVMH as the biggest company in Europe. We have big holdings there. They do a tremendous job. And it's really, really exciting what this can do, not only to obesity, but also to all the other various illnesses which are related to it.
Nikolai, what are your thoughts on rebalancing when a name becomes the biggest holding, or at least one of the biggest holdings that you have? Do you just stick with your winners? Is that your approach?
We try to stick with winners. It's, just in psychology, many people want to sell the winners. The way to make money is often just to ride the winners and continue to be in there. And we would typically do that anyway because we are a relatively index-near fund. So that's why we do it.
Nikolai, wonderful to get your input today. Fantastic to catch up. Nikolai Tangen there of Norge Investment Management. Bramo, where do you want to begin? Novo Nordisk, one of the biggest holdings now, given how much that's appreciated over the last 12 months. Real estate, I like this idea that if you wanted to be the ultimate contrarian right now, pull away from AI, pile into property.
And he said not necessarily doing that. So I wonder how contrarian he is if he is going into artificial intelligence and also betting on the U.S.
Jill, let's talk about real estate if we can just a little bit. You mentioned it earlier. Do you have a different view on commercial real estate? And is your view on commercial real estate different to your overall view on CRE across the nation? And what I mean by that is your bank exposure might be one thing, but do you think that speaks to the broader story at the moment?
Yeah, I recently saw a survey of banks that were confident with their own commercial real estate holdings, but not necessarily really confident broadly. And I think it has to do with just that there aren't as many banks in commercial real estate. I mean, as far as like looking at the whole portfolio, only 50% or so is financed by banks. I feel really comfortable with our portfolio. We have always been a real estate concentration bank, and have great risk management tools. I mean, as a banker, you have to be an expert risk manager, and so it requires discipline going into higher risk type of lending. And so making sure you really understand, is this debt service coverage ratio real? And is this value? Is this appraisal we got reasonable? What is the value looking like over time?
Does it make you nervous that everybody else thinks their bank book is okay and everybody else's is the problem?
Yeah, well, it would on the surface, but when you look at the composition of how real estate's been financed, there's been lots of deals we passed on that non-banks have financed. And so I think there is a lot of that market mix occurring. Banks have great tools, so we can also, re-amortize. We have flexibility when it comes to restructuring rates. We've all been through workouts before. So as long as you go in with your eyes wide open, that you're working with borrowers that know have great integrity, you you should be okay.
You're going to stick with us, I'm pleased to say. The broader equity market right now on the S&P 500 negative here by 0.1%. Coming up next, Bloomberg's Craig Trudeau on GM's blockbuster fourth quarter earnings. That's coming up very shortly. That stock is up by almost 8% in the pre-market. From New York City, you're watching Bloomberg Surveillance. Live from New York City, stocks pulling back on the S&P 500, negative here by 0.1%. On the Nasdaq, down by 0.07. The Russell, a little softer, lower, down here by 0.14%. Tons of earnings. A little bit later on this afternoon, we'll talk about big tech through the program. In the bond market, 2-year, 10-year, 30-year shaping up as follows. A 10-year yield down a basis point, 4.06%. Let's call it 4.31 on a 2-year, down by not even a basis point to 4.31.38, Lisa, after that Treasury refunding announcement of the last 24 hours.
Basically, the Treasury Department isn't going to borrow as much as people previously thought during this year and particularly during this quarter. And this really does put, or at least alleviate some of the pressure with respect to supply that could have potentially pushed up yields. It's kind of a smart move because you got to think that later in the year, yields are going to be lower just simply because the Fed's going to be cutting and ostensibly the economy is supposed to be slowing down.
What's the deal here? Was the bar just too high? They set the bar super high and then they could basically come under expectations. Was it tax receipts, money coming in? What is it?
Yes. I mean, basically, it's everything. I mean, they said that tax receipts came in a little higher. Some people are speculating that actually that might be the sleeper surprise this year. The tax receipts will come in better because of some of the returns that we've seen in the markets. There are a lot of questions around also whether this is just clever maneuvering, again, because it keeps the pressure off rates, helps the economy, and potentially you can deal with it later.
Well, the numbers are still pretty staggering. Let's put it that way. These are massive numbers. There is coming in below expectations, and then there is still a number which is like out there.
Net $760 billion being borrowed, which is down from the expectation of north of $800 billion. But we're talking more than $4 trillion of bond sales this year just to keep financing, and that only continues to increase from there.
Amazing. I want to turn to crude just briefly, take a look at WTI and take a look at Brent as well. Crude shaping up as follows. We're negative 0.5%. Just the surprise, I think, for many of us. Monday morning, first thing many of you looked at was the price of crude after the attacks over the weekend. Annmarie, to see the price of crude down yesterday, down again today.
It's pretty astonishing given what we're seeing in the Middle East and the fact that everyone is also now starting to look at the risks of this extending a wider conflict because the U.S. is promising to respond to that attack that happened on U.S. troops in Jordan. But also, crude hasn't bounced at all. There's been 160 attacks. There also was an attack on a Trafigura vessel carrying Russian naphtha, and crude didn't move. So this is where we are in the world until things, I think, really start to become very volatile.
Incredible. Let's get you an update. Under surveillance this morning, Iran urging the U.S. to use diplomacy as pressure mounts on President Biden to respond to the attack which killed 3 American soldiers in Jordan last weekend. The U.S. blaming Iran-backed militia for the drone strike, Iran denying any involvement. Lisa, still trying to figure out what the response is going to be from the White House.
Especially because there has to be a response. And at the same time, it's clear that nobody wants an escalation. Well, this is an escalation. At what point is this these attacks? And we talk about 160, 170 attacks on U.S. military personnel in Iraq and Syria since October 17th. You have to wonder, okay, so one slipped through. But the fact is there's been 170 attacks. So what are we talking about here, and how do you prevent some of this?
Well, when you look at potentially what we could see, Secretary Blinken said yesterday they're going to be multi-leveled, come in stages, kind of what John Lieber of Eurasia Group said. But Politico has reporting that the Biden administration is also considering one option, which would be a bigger escalation, and that is attacking Iranian personnel, say in Iraq or in Syria, and that would send a serious message.
I want to turn to our second story. Markets in China sending clear signals to Beijing that more needs to be done to revive investor confidence. Stocks falling for a third consecutive day, while China's 10-year yield dropped to the lowest level in more than 2 decades. Traders betting the country's central bank will deploy more stimulus to boost growth. China in a very different position, Lisa, to the US over the last year.
Maybe this would be the third contrarian bet for Nikolai Tangent. Go long China, because it seems like that's one of the questions that people have, and how much that's going to hinge on this idea of additional stimulus. What can they actually do, though? If this is an issue of consumers not wanting to spend money, cutting rates isn't going to help. It hasn't been an issue of credit supply. It's been credit demand. It's harder not to crack.
They've got to restore confidence, and that's tremendously difficult to do. And we've been talking about the US on an island. Exceptional growth versus stagnation in Europe and trouble in China. The three-legged stool of global growth right now. Two of the pegs of that just not great right now at all.
And how long can the U.S. continue to be sort of on its island with AI kind of fueled growth? You know, this has been the outlook, which is a reason why people have been surprised continually by the ongoing strength.
Let's pick up the strength this morning. GM in the pre-market climbing much higher than I think any of us anticipated, up by close to 8% in early trading. The automaker saying adjusted earnings before interest and taxes for 23 came to $12.4 billion at the high end of its November forecast. GM expecting auto sales to climb around 16 million vehicles powered by its core business of gas-powered trucks. I should also say, predicting some growth in EV sales as well. So Mary Barra later on today, about 10:15 Eastern Time on Bloomberg TV. Lisa, with a better story to tell, based on what we've seen for the sector over the last 12 months.
And surprisingly so, at a time when some people had previously come on this show and said that autos were uninvestable because of some of these uncertainties in terms of policy and electric vehicles. It turns out that's even less relevant because at the end of the day, people are still buying gas-powered cars. They want their trucks, and they're buying them at a greater volume potentially or a higher price point than at a time when rates were higher and borrowing costs were higher. So I am curious to hear from her and them how much rate cuts are going to help their sales.
Jill, I was surprised by this. I think you were too. What does auto lending look like for you in the bank?
Yeah, we've seen less demand for car loans, and so the rates are driving consumers not to purchase whenever I look out on the ground. But there is some demand up there from like I couldn't buy a car a few months ago or a few years ago, and so now it's time to buy one. But I think we will see some great demand. There is demand kind of pent up because the rates have been high. We've seen consumer debt go up as well, and it being more difficult to have the savings that we saw during COVID and even pre-COVID. So this is surprising data for me.
What greases the wheels for you? Can you give us an idea of the number? We talk about moves of 50 basis points, 100 basis points, 1 full percentage point on Fed funds coming down, and that's going to get things going again. Does that move the dial for you when you drop rates that much? Do people start lining up to borrow money to buy cars?
Well, not necessarily buy cars, because I think we're still seeing a lot of auto financing incentives from the dealers and from the manufacturers. So, I don't really see that as much because I think their other debt is what's causing some stress. So it's not necessarily going out and getting necessarily the new car loan. Definitely on the used car loan, you would have a higher debt, higher rate associated with that. But the other demands upon and the perception of what the rate would be, I think it's keeping folks from purchasing.
Can you give us an idea of rates to borrow right now? What does it look like if we come to the bank to you today? What am I paying? I'm not paying 550, which is Fed funds. What am I paying?
Yeah, you're right at the prime rate, and so you're maybe a little bit less than that. So, but you can still go to dealer finance and get quite a bit lower. And so they're really kind of, and I don't know what GM is doing, but they may have some incentives and be interesting to look at that.
Lisa, I was surprised to see the strength in GM this morning. The stock's doing better than good.
How much of that is fueled by people buying all in cash? That's what I'm curious about.
I know.
At a time when the prices aren't going up as much, because if you are going to have to pay an 8, 9, 10% rate on a car, it's not really going to be that attractive for a lot of people.
It's like an apartment in New York City or an EV. It's like one or the other. Bloomberg's Craig Trudell.
Why do you get a tax rebate?
Craig, let's start here. The strength was a surprise to a lot of us. Craig, where's it coming from?
I do think this is a company that is sort of hitched to that stronger U.S. economy. We didn't think that we were going to see a soft landing, and albeit we've managed to see some real strength in the U.S. This is a company that, as Lisa was saying, is really reliant on big trucks and SUVs. It's not necessarily what generates the headlines anymore, where we pay a whole lot more attention to electric cars and to self-driving vehicles. And honestly, the execution in those areas for GM has been pretty weak lately. But what we've seen is a company that had some real disruptions late last year with the UAW strikes. A lot of makeup production toward the end of the year after the strike by the UAW. Once that was resolved, and looking forward into the new year, not having as much investment going into Cruise, the self-driving unit. And of course, not having to worry about a disruption on the labor front. You don't have to account for that for another 4 years.
Craig, we were just talking about auto loans and how high they've been recently. A lot of people having underwater loans, even with their car values depreciating at a faster pace than their loan. How much do you think the rosier outlook for GM is hinged on this idea that rates are going to be lower and it's going to be easier to borrow to make those purchases?
I think to the point raised earlier, the fact that GM has an in-house financial lending arm allows for them to do some subsidizing of borrowing costs for customers. Of course, there's not quite a situation where you can entirely offset the fact that borrowing costs have increased, but there is some ability to have some flexibility there if you're GM or Ford. These are our lending units that are extremely strong, and as much as we've seen some weakness in some of the numbers looking at sort of the health of the auto borrower and the fact that a lot of loans we've seen some underwater loans soon after the point of sale. We are seeing some pretty strong demand for cars in the U.S. When we're talking about 16 million unit outlook on GM's part, that's basically peak roughly peak sales volumes for the U.S. And I do think that we've gone through a few years now of customers not being able to go to the market because of the supply chain issues, the lack of supply of vehicles out on the dealership lots. Now that those are no longer depleted, customers are seeing deals out there and deciding to pull the trigger.
Craig, let's talk about hybrids. I think this is really important, where the market is and where it's going. So we're moving away from the internal combustion engine. Policy is pushing us in that direction. The ultimate destination seems to be EVs. The question for the auto manufacturers over the last few years is whether you want to engage in an interim step and lean into hybrids. Some manufacturers do. GM has pushed back against that. Do you think we might see just a subtle shift there in the quarters to come?
I think we're seeing a real aggressive shift there on the part of Ford. And to your point, GM has been a sort of, all EV or bust company. I think we've, interestingly, picked up on dealers really pushing back against, going all EV. They really sort of want to be the gatekeepers here. And there is a question of just how much of that is a reflection of what the consumer wants and is asking for, and how much is it a matter of, dealers sort of protecting where their bread is buttered. If electric vehicles have fewer, parts that break down, and that means less, parts and service revenue for the dealers. This is not a transition that they want to make. And so how much that is sort of coming into play here for the incumbents, I think is something that we have to look at closely, given how many challenges they've had with, executing this transition.
Hey, Craig, thank you, sir. Craig Trudeau of Bloomberg out of London. Be sure to watch our interview with the GM CEO and Chair, Mary Barra, 10:15 Eastern Time. We'll talk about that, Lisa. What is the Wayne Gretzky School of Management? You want to skate to where the puck is going. Where's it going to be in a couple of years? Are we going to be stuck here in this interim moment with hybrids and they haven't moved back in that direction quickly enough? Or are we going to be there, full scale, EVs?
It has a lot to do with price. And I do wonder, a lot of people saying that it's going to be really horrible for U.S. auto manufacturers if Chinese auto manufacturers can sell without any barriers. At the same time, a lower price point is what's necessary to bring people into the electric vehicle market. So you're between a rock and a hard place because the manufacturing is just too expensive to sell at the price point that many people want. How do you get there? It's not going to be that simple.
General Motors right now, firmer in the pre-market by more than 7%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. British distiller Diageo reporting lower than expected sales and earnings. The company has shown impressive growth for years with successful bets on products like tequila. But recently, demand has cooled in the U.S. and Canada. CEO Deborah Crude speaking to Bloomberg earlier.
We are looking for improvement in the second half on our top line versus what we delivered in the first half. And we're looking at gradual improvement, and that's off the back of gradual improvement in North America.
Meanwhile, JetBlue reporting a smaller than expected loss in the fourth quarter, while its revenue topped forecasts. The carrier citing continued strong demand during peak periods, likely fueled by holiday travel. JetBlue reporting as it undergoes a C-suite shakeup with Chief Operating Officer Joanna Garrity taking the reins as CEO this week. Meanwhile, its possible merger with Spirit Airlines is becoming increasingly unlikely. Both appealed a ruling blocking the deal. And fans hoping to attend this year's Super Bowl in Las Vegas will have to fork out a record amount, with the average ticket price coming in at $9,800, the most expensive ever. That's just to attend the match between Kansas City and San Francisco. Rooms at some hotels are going for more than $1,000 a night. No word yet on whether Taylor Swift will be in attendance. That's your Bloomberg Brief. John?
Yahara, thank you. Lisa says you can blame Taylor Swift for the price of those tickets. They're not going to watch Usher, are they?
Hold on.
You're not paying $10,000 to watch Usher, are you?
My kids didn't even know who Usher was, which tells you exactly.
I already think he has a whole showing in Vegas. That's much cheaper.
He does.
Honestly, all I could say is people are going to be writing about this. The Taylor Swift effect that we're talking about, the Beyonce effect. And so this is going to be, the sort of Barbenheimer moment. It's going to be the, Swift Bowl or something that we're going to be talking about in some of the economic reports. I just am suggesting that we might hear about that.
We'll talk more about this a little bit later. Up next on the program, equities hitting new all-time highs with tech earnings on deck.
Valuations might be a little bit extended, but these are also the companies that are growing far beyond the broad market and far beyond the economy.
That's coming up next on the program, live from New York City this morning. Good morning to you all. This is Bloomberg. Live from New York City, equity futures on the S&P 500 are looking like this. We are negative by 0.16%. Yields totally unchanged, 4.0681% on a 10-year. The surprise of the week so far. Crude is not rallying. It's selling off. It was down yesterday by more than 1%. It's down this morning by 0.6%, $76 and about 35 cents. Under surveillance this morning, equities hitting new all-time highs with tech earnings on deck.
In many cases, the Magnificent Seven, or many of the Magnificent Seven, are actually delivering on the promise. So yeah, valuations might be a little bit extended, but these are also the companies that are growing far beyond the broad market and far beyond the economy. What I'm looking forward to, given average valuations in the other 490 names, is and international markets, can we see this broaden out?
Can we? The S&P 500 topping 4,900 with Microsoft and Alphabet due to report after the closing bell. Marko Kolanovic of JP Morgan saying tech earnings will be crucial in determining whether valuations are sustainable right in this. As long as the market stays narrow, heavily concentrated and tech-driven, the US, Lisa, is likely to have the upper hand.
So let's put some numbers on this. Exactly how much they've outperformed. DataTrek's Nicholas Colas and Jessica Reeve put this out there, that if you take out Amazon, Alphabet, Apple, Meta, and Microsoft, as well as NVIDIA, S&P earnings would be down 11% in the fourth quarter of last year, flat in the first quarter of this year. That's why big tech continues to rally. It's not just a pipe dream. This isn't 2000. This isn't 1999. This is a matter of companies that are actually getting it done and delivering the profits that other companies just are not seeing in terms of growth.
Let's build on that with Annmarie Hordern, Co-Chief Investment Strategist at John Hancock Investment Management. Yes, it's narrow. Yes, it's problematic in the minds of so many. But, Emily, is it a problem when that's where the earnings growth is?
Yeah, it's absolutely critical that tech can hold up here. You look at the S&P 500 growth index, and it's now trading at a 45% premium to its 20-year average. Now, to us, it makes sense that tech and quality more broadly have been rewarded in this environment. You're thinking about companies now that don't need to tap the capital markets in order to grow. And we know the cost of capital is elevated. These companies have tons of cash. Of course, AI. Can't say it enough. Productivity is going to be one of the keys to growth. And these are companies that are best in their industry. They've got the financial metrics. But again, they're pushing up against valuations. You look at earnings growth and flat's the new up. Tech earnings are revisions are up modestly while the rest of the S&P 500 is decelerating. So this is a big test this week. You guys were talking about the Super Bowl during the break. This is the Super Bowl for investors this week, not only with tech earnings, but with a flurry of macro data as well. I'm sure you guys are having a hard time sleeping at night this week, just like I am.
I don't know. A lot to unpack there. I slept fine, but I'm curious going forward about what we're going to see with respect to the vulnerability of a market that is so top heavy, right? The fact that you've got this level of concentration in these names is the bar just incredibly high for them to continue to really push up some of their forecasts. And if they don't really outperform, that's going to be a problem.
Yeah, Lisa, it's a key reason that we think diversifying away from some of those names is critical. Look, we're not downgrading tech. It still ranks the highest on quality, which is the key factor that we're emphasizing. But we're looking at other areas that are actually trading at a discount. You can find that right now. Areas like U.S. mid-cap equities are trading at about a 25% discount to their large cap counterparts right now. In particular, we're looking at mid-cap equities that are benefiting from onshoring trends and fiscal stimulus. By the way, we are still spending, and we're spending quite a bit as far as things like the Infrastructure and Jobs Act and the CHIPS Act and the Inflation Reduction Act. All of that is being funneled into industrial production in the United States right now. I've been on the road a lot lately. The Midwest is absolutely booming. So we're looking to play that onshoring theme by investing in industrials companies, particularly in the mid-cap space here in the United States.
What do you make of the fact that given that strength and given the fact that you're talking about a booming Midwest, we've seen disappointments in earnings really punished in markets, and outperformance has not been incredibly rewarded, even with some of the discounts that you're talking about on share prices?
Yeah, we're certainly seeing that. And again, even though the bar is being lowered here, you look at earnings growth broadly for the S&P 500, it's up only modestly over the past 3 years here. Again, this market has really been driven by multiple expansion. You look just last week and you actually saw earnings revisions come down for the first time in quite a while at the same time that prices continued to go up. And again, the macro environment's been such a key driver, this Fed pivot, the soft landing. Now we're back to no landing. And I think that's really been the key driver of pushing sentiment higher. Now we're kind of up against that 20 times forward earnings. We haven't been this high in terms of PE multiples since, 2001, 2002. So we're at this place where the macro is really driving sentiment here, but we've got to start to see that fundamental piece kick in order to really see the big upward move that a lot of investors are expecting.
Jill Castilla, the CEO of Citizens Bank of Edmond, with us today, Emily. I want to turn to Jill. The Midwest is booming. Let's put that in a headline. Is that what you see as well? Is this conversation about recession just totally foreign to you?
I mean, it really is. The onboarding of, whenever we look at battery manufacturers coming into states, the small business initiative money that's coming from the Treasury that's yet to be distributed, there is just so much that we need more engineers. We need more. We have this mass influx of people moving to Oklahoma, where I am, and the Midwest, and we still don't have enough workers to be able to fill these jobs that we're anticipating being there, not even the jobs that we currently have.
Emily, let's get to that. If the Midwest is booming and the US is doing so well, why don't I want small caps, just domestically focused small caps, instead of being exposed to this multinational story, and just avoid places like China, places like Europe, which just can't put up the growth in the same way?
Yeah, John, to us, it's really about rates and the debt burden that a lot of these smaller cap companies have. About 50% of the Russell 2000 index is comprised of companies that don't make money. So in this environment where we do think that the lagged impact of Fed tightening is going to cause challenges, is going to cause margins to compress, we simply think going up in market cap makes sense for investors as balance sheets are better, as interest burdens are lower. And we like mid-cap equities for that reason. Up in market cap, to your point, you're going to get more multinational exposure. We're underweight China. We're underweight emerging market equities. One of my favorite economists, Nancy Lazar from Piper Sandler, told me recently that her favorite emerging market was Middle America. And I thought that was so powerful. So we're really using that as a way to lean into areas not only that are benefiting from these trends, but are also trading at a discount.
I'm not sure how Middle America would feel about that, but I understand it's meant to be a compliment. Emily, we appreciate it.
Yes.
Emily Rowland of John Hancock Investment Management. I'll clarify that for everyone. I think they're talking about the degree of growth, the level of growth that you get in Middle America right now, Bramo.
Not necessarily that things aren't run well.
Not how developed it might
exactly,
be,
and that the infrastructure is sort of lacking in its quality. I'm hearing this incredible strength. I'm hearing Nikolai Tangent speaking with CEOs in America. Things are booming. Is that commensurate with inflation coming down? I don't know. I mean, this to me is one of the key questions here. Are these stories kind of fitting together?
I know the White House often listens to this program, so if they are this morning, I'm sure they're hoping that this shows up in the polls sometime soon.
I imagine
because
so.
This is not how people respond to that question, or at least not how they have been responding in the previous 12 months.
And that's partly because you've seen a 19% increase in CPI in consumer prices since 2020. That's tough to swallow.
Jill, it's good to see you. Thanks for being with us. Appreciate it.
Great to be here.
And send our love to Esther George, favourite Fed official, formerly the Kansas City Fed. Just the absolute best.
The best.
Loved her. The absolute best. Jill, thank you. Equities on the S&P 500, slightly negative this morning. Coming up in the next hour, Phil Camporelli of JP Morgan Asset Management, Stephanie Roth of Wolfe Research, and Derek Wood of TD Cowen from New York City. This is Bloomberg TV.
I think the market's already pricing in the rate cuts to a certain extent.
I don't think the Fed's going to move this month. I think that they may send a signal to help people begin to ground their expectations.
They want to send a consistent message to markets that policy is consistently moving in an easing direction.
I don't think we're in a situation where we're going to be seeing a pivot, unfortunately, which I think is what the market has probably been broadly expecting.
We've taken the punch bowl away and markets haven't fully adjusted.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
In many ways, earnings season begins right now. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500 down by something like 0.1%. Nothing against the big banks on Wall Street. It's just this week is the week that really matters when the big market cap tech players report earnings, and that begins, Lisa, after the bell.
I'm guessing they're actually not offended because probably a little less attention is welcome. I am curious, though, to see how much some of the big tech names can deliver after the bell. We do get Microsoft, we do get Google, Alphabet, if you want to call it that, AMD as well. Interesting to see whether people are going to be looking for some sort of monetization of AI or simply a monetization of advertising, YouTube, and some of the cloud spending that we've seen in the past.
There's something for everyone this morning, so let's talk about what there is for the bulls and what there is for the bears. For the bears, look to UPS. UPS is down by something like 7%. The outlook, not great. For the bulls, GM. Stock is up by more than 7%. The outlook is better. Pick your poison.
There's a lot of stories underneath this. At this point, UPS also is dealing with pretty stiff competition for Amazon, but it's the physical world right now versus everything else. Not getting a clear read on whether you're getting some sort of recovery or not. Either way, it seems clear that the physical world, when it comes to auto manufacturing and when it comes to certain consumer goods, seem to have been doing a bit better than expected. But again, a pretty mixed picture out there right now.
Listen to what we just heard from a small community bank in the last hour, that the economy's doing really well. From Emily Rowland of John Hancock just 5-10 minutes ago, who Annmarie turned around and said the Midwest was booming. Booming.
Yeah, it's unbelievable, especially when you pointed out what's happening given the polls. People continuously say they're not feeling it. They need to more than 5% in the latest Morning Consult poll of their wages to go higher to combat inflation. But also look at all the fiscal money coming out of Washington on these infrastructure projects. A lot of that you're seeing in the Midwest. So it's a good timeline from now until November.
Now compare that to what you're hearing out of Europe, stagnation. What you're hearing out of China, a struggle. The IMF, by the way, just raising the 2024 global GDP growth outlook to 3.1% from 2.9%. I imagine there is a certain country responsible for some of that shift higher.
Yes, and I think that it rhymes with America. I mean, this is basically the idea of the United States continuing to really drive a lot of growth in artificial intelligence as well. Although, that said, you were pointing this out earlier, John. We're talking about stagnation in the Eurozone. That's a win. It's not a recession.
Yeah, the bar's low.
So, I mean, we're talking about better than expected GDP results from the likes of Italy and Spain. So at a certain point, all around the world, even the laggards have been doing a little bit better than a lot of people had expected.
Let's turn to the price action. Equities right now in the equity market stateside. Equity futures negative by 0.2%. In the bond market, yields lower by not even a basis point, 4.0662% on a 10-year. Foreign exchange, the euro, 108.45, firmer by 0.1%. And just to finish on crude, I think it's worth going over again. Annmarie, to see this negative 0.6%, 76.30, down today and down yesterday.
Yeah, it's pretty remarkable. Amrita said this morning that part of this is the fact that you still have tankers with the supply. Supply hasn't really been impacted. It's just been drawn out and how long it's taking to get to its final destination. But there is a risk in the oil market. It can change really on a dime if the Middle East does escalate with this tension.
Brent crude also lower, 81 87. Coming up this hour, Phil Camporelli of JP Morgan Asset Management looking ahead to tomorrow's Fed decision. Stephanie Roth of Wolfe Research on Friday's payrolls report. And TD Cowen's Derek Wood previewing Microsoft earnings after the bell. We'll get Alphabet as well. We begin with our top story this hour. The Fed's two-day meeting begins. Phil Camporelli, Multi-Asset Solutions Portfolio Manager at JP Morgan Asset Management, writing this. We expect rate hikes to start in either May or June, or rather rate cuts, and we expect 3 to 4 25 basis point rate cuts. It's hard to imagine a March cut with a combination of December CPI and jobs, but the narrative could change quickly after new rounds of payrolls and inflation data. Phil, I'm pleased to say, joins us right now. Phil, good to see you.
Good morning.
Let's talk about those rate cuts. They're going to come in March. So you've said it before, we've moved from the hope of a soft landing to the reality of one. Why does that allow the Federal Reserve to reduce interest rates?
Yeah, so I was here the first week of January, and I was so happy, right? Because hope is not an investment strategy, and we're actually in the reality of that soft landing. And I've been really impressed, John, this month. I think this month was critical because we got a very strong payroll number, first week of the year. We got a very strong retail sales number, and we got an above consensus CPI number. Also, initial jobs claims in the middle of the month were in the 100,000s. Yet, equity markets continued to make a new high. March, the probability for March went from 85% to below 50, and equities were still able to continue to march. So our take is good news is good news. It's not good news is bad news. We're done with that, okay? And Chris Waller, I think, said it best 2 weeks ago when he said, as long as, and Lisa, you've been talking about this as well, as long as inflation doesn't, accelerate from here, we will carefully and methodically, those were two very important words, move interest rates down. March just seems a little premature. I think 50-50 is a good probability because, again, we do get payrolls on Friday. We get another CPI number. But nevertheless, they are on the move downwards. And I think that's what's leading to the financial condition easing, resiliency of the consumer, and us only have a 20% probability of recession. We're embracing this environment, John, especially
Tell me how you're embracing it. Are you upping your exposure to equities?
Yeah. So, John, we have our largest overweight to equities in over 2 years right now. Since before that, first hike in March of 2022, which then later that year led to 475 basis point rate hikes. And I was here. I was less giddy than I was to this morning back then when that was happening. And because, John, this is why. Like, diversification makes sense again. Bonds were the problem when the ag was on pace for 3 negative calendar years in a row through Halloween of last year. That was only 2 months ago. And now bonds could be a solution as long as all of this kind of goodwill does not lead to an acceleration of inflation.
How are you the most overweight stocks in 2 years? Is it just really on an index level that is really hinged to some of the big tech names? Or is it broader?
Yeah. So, Lisa, we're staring at the charts. Things like small cap, it's like the mother of all contrarian trades right now if you look at it versus NASDAQ. However, it's so hard for us to compete with the S&P 500 right now, right? It's so hard for any allocation to compete with that. So our largest and highest confidence overweight is the S&P 500. That includes cap-weighted. We're looking at the cap-weighted versus equal-weighted. We know that equal-weighted is a decade cheap to cap-weighted. But we can't yet look ourselves in the eyes and say, let's underweight those names. So we continue to pile into the S&P.
If Stuart Kaiser were listening to this, he'd say, finally, people all agree with me and that good news is good news, bad news, cut it out with that whole kind of paradigm. But there is this question about what could go wrong. And I'm sorry to be that person, but
Don Constant was that person yesterday.
I know. That was actually, truly a bit of a downer. But I'm just wondering, when you look at all of the economic data, what will signal to you, hold on, maybe we need to reassess?
Yeah, so it's the labor market, both ways. Okay, so the left tail risk is recession. The right tail risk is too much good news that then leads to an acceleration of inflation. So it's the labor market, and specifically wages. We have been very, very pleased, right, that when wages topped out at 7% annualized, the average wage growth, Lisa, is like 4.5%. We were on the precipice of a wage price spiral 2 years ago when the Fed started raising rates in March of 2022, where net wages are now at roughly 4.5%. That's sitting right on top of long-term averages. That's the picture of the soft landing. is the wage growth. Now, the other way, if you start to see claims going up to 250, 300,000, very, very close to no jobs created, then we're going to be saying, okay, there's business caution here that we have to worry about, that we would take our equity underweight down. But we're sitting right in this base case of soft landing right now.
So you have this 20% probability of recession.
Yes.
So the catalyst for you is the labor market.
Yes.
When would you see this in 2024?
So the 20%, Annmarie, sits basically right on top of a normal kind of probability. Every year we come into, it's 15%, because you can never assign a zero probability to any event. So our base case is that we don't see it, okay? With what we know now about the inflation data, I think the easing of financial conditions that the Fed is going to bring on actually prevents that from happening. So we are, overweight high yield, overweight equities. These are no recession trades, so we don't expect it this year.
So overweight all of these things, does that mean underweight full faith and credit U.S. government bonds?
Yeah, so we'd rather play offense than defense in fixed income. So our core bond allocation, if I have to wake up every day and try to beat a 60-40 portfolio, we only have 20% in core bonds. So we're underweight core bonds by a pretty significant amount and replacing that with yield and carry in the high yield market.
You have been underweight EM as well.
Yep.
Why isn't this rate cut talk lifting all boats?
So, good question. I think the emerging markets have the biggest vulnerability, good or bad, to global growth. Now, you mentioned the IMF just upgraded the global growth forecast. I guess we just have more confidence when we're thinking about how do we deploy risk in the developed world, specifically in the U.S. There are stock-specific examples, John, things like Samsung, things like Taiwan Semiconductor. There are stock-specific examples that we're interested in. But from just a pure beta perspective, where are we allocating customer cash? The U.S. is the prettiest house right now.
Phil, stick with us. Phil Camporelli there of JP Morgan Asset Management. The broader market negative here by 0.2%, about 1 hour and 20 minutes away from the opening bow. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. The IMF has raised its global growth forecast, citing strength in the U.S. economy and more fiscal support in China. It says the world economy will grow 3.1% this year. That's up from 2.9% seen in October.
We see a lot of resilience in a number of economies in the US, in China, and in many large emerging market economies, Brazil, India, Southeast Asian economies, Russia. So all of this together, that's what is lifting the growth number for this year.
Despite that, the IMF warns inflation and geopolitical tensions still pose downside risks to the global economy. General Motors reporting better than expected fourth quarter earnings and expecting 2024 profits to grow on improved U.S. sales. GM's expecting demand for vehicles to stay robust, in part due to optimism about a soft landing for the U.S. economy. While GM is struggling to build out its EV line, its legacy business of gas-powered vehicles continues to be a cash cow. CEO Mary Barra saying, quote, "Consensus is growing that the U.S. economy, the job market, and auto sales will continue to be resilient." And Elon Musk says the first human patient has received a brain implant from his Neuralink startup. Posting on X, quote, "The first human received an implant from Neuralink yesterday and is recovering well. Initial results show promising neuron spike detection." Neuralink says it expects to perform 11 surgeries this year. The company's end goal is to one day allow humans to control computers with their minds. That's your Bloomberg Brief. John?
Yahara, thank you. I think Phil's hoping that Jamie Dimon doesn't get any ideas anytime soon. Right?
All I could say is how many of the younger generation want a chip planted in their brain? It just sort of like removes the barrier of having to look at a screen.
No, thank you to all of this. Up next on the program, pressure mounting on the Biden administration.
We will respond decisively to any aggression, and we will hold responsible the people who attacked our troops. We'll do so at a time and a place of our choosing.
President Biden walking the tightrope after the deadly attack on U.S. forces. That conversation coming up next. You're watching Bloomberg TV. Live Live from New York, 1 hour and 15 minutes away from the opening bell. Stocks pulling back just a touch from all-time highs. Equity futures negative here by 0.2%. Crude is lower. Again, believe it or not, we're down by almost 1%, $76 and about 2 cents on WTI. Under surveillance this morning, pressure mounting on the Biden administration.
Anyone looking to take advantage of conflict in the Middle East and try to expand it, don't do it. We will respond decisively to any aggression. And we will hold responsible the people who attacked our troops. We'll do so at a time and a place of our choosing.
Here's the latest this morning. Iran denying involvement in this weekend's deadly attack on U.S. troops in Jordan. The country's foreign minister saying active diplomacy is underway, writing on X, quote, "The White House knows very well the way to end the war, Annmarie. The current crisis in the region is political."
So Hossein Amir-Abdollahian, the Iranian foreign minister there, talking about the fact that they want the U.S. to put pressure on Israel to end the war in Gaza. Jonathan, though, Secretary of State Antony Blinken shed some more light yesterday on just how dire the region is becoming, saying, "I would argue that we've not seen a situation as dangerous as the one we're facing now across the region since at least 1973. Exactly 4 months ago, on September 29th, 2023, Jake Sullivan, the president's national security advisor, said it's the quietest it's ever been.
Do you think that makes them hesitant when they come to formulating a response now?
I think potentially they decided to claim victory on the region before the end of their term was up. They have been hesitant on a response because this administration has made it absolutely clear they do not want a showdown directly with Iran.
To weigh in on all of this, Elliot Ackerman, the U.S. Marine Corps veteran and a former White House senior fellow, also the co-author of the novel 2054. Elliot, wonderful to get your perspective on this programme, sir, particularly after the tragic event over the weekend where 3 U.S. servicemen died. Elliot, your view on what took place and ultimately your base case, if you have established one, on how the U.S. will respond.
Well, I agree with what was just said, that, we've seen a series of escalatory strikes by Iranian proxies against U.S. targets in order to try to leverage the U.S. to apply more pressure on Israel. And that's been going on since the October 7th attacks. And now it's sort of reached a crescendo with 3 dead U.S. service members, and their deaths demand a much more forceful response on the part of the United States. And so, President Biden right now has got to thread the needle on what our response should be. And generally speaking, he can respond in sort of one of 3 buckets. The first bucket being a response against Iranian proxies in Iraq and Syria, and even in Yemen, who've been launching these attacks. The second bucket would be a strike on Iranian targets abroad, military targets. And then the third bucket would be strikes inside Iran. And so, he is going to have to launch a strike kind of in either one of these 3 buckets or a response that combines, elements of each. I think that's the decision that the administration has to make right now.
Secretary Blinken said it's going to be multi-leveled, comes in stages. So do you think that they will go for the least offensive response and then work up to something more harsher, or they come out with something very strong to try to send a message to Iran and their proxies to back off?
I think they could do a little bit of both. I mean, I think it could be a very forceful response that arrives in the coming days. And I would imagine that most forceful and sort of visual response would be against Iranian proxy groups and the groups that were responsible for this. And potentially uniformed military assets that the Iranians have in places like Syria. But then you could also see sort of a slower, quieter response either inside Iran itself, a non-kinetic response, for instance, like a cyber attack inside of Iran, or potentially the targeted killing of high-level Iranian assets. I would say probably not inside Iran, but potentially outside Iran, akin to the killing of Qasem Soleimani, the leader of the Iranian Quds Force several years ago.
There's a lot of reporting, I have it on my own account as well from sources, that when the Trump administration did go after Qasem Soleimani, the Iranians were frantic, telling interlocutors in Europe to tell the United States, we are done, we're going to back off, we're going to send some retaliatory strikes in Iraq just for show of domestic force. Would that track on potentially something we could see play out here if the Biden administration was willing to go after, say, someone from the Quds Force?
Well, and I think I think Soleimani is worth reflecting on, because I think that was probably an example where the U.S. response, as you noted, caught the Iranians on the back foot. They didn't think the U.S. would respond so forcefully. And so through our escalation, we saw a Iranian de-escalation. And I think that's the type of response that we want to see right now. So the question becomes, what is that target or that set of targets in which our response, the United States response, will give the Iranians pause and say, hey, maybe this strategy with putting leverage on the U.S. and these strikes where we think that's going to get them to speak to the Israelis or apply pressure on the Israelis, maybe this strategy either isn't working or has become too painful for us, and we need to adapt different measures and de-escalate these attacks. And I think that is what the administration is hoping will be the result of our response.
Back then in 2020, the response from Iran to the killing of Qasem Soleimani was retaliatory attacks that did not necessarily kill any U.S. troops, but did cause brain damage. And we heard about similar cases of brain damage, or brain trauma, I should say, to certain troops who were still stationed in Syria, in Jordan, in the latest attack. How concerned are you about some of the brain trauma that's happening among some of our 42,000 troops from the U.S. that are stationed in the Middle East amid an escalating conflict?
Sure. I mean, I think important to put in a larger context, right? It's like, we've been fighting a proxy war with Iran, for decades. I served as a U.S. Marine in Iraq and Afghanistan, and as far back as, 2004, we were fighting Iranian proxies in Iraq and in Western Afghanistan in 2008. So Iranians have been causing brain trauma, and a lot worse, to U.S. service members for decades now. And I think now we have 3 dead Americans, and the blood is on Iranian hands. And the most important thing is to adopt a response to make sure we don't see more dead Americans killed by Iranians, or frankly, Americans who are wounded, whether those wounds are, loss of limb or brain trauma. So we need to get out of this cycle. And I think what we've seen is sort of these gradual responses from the U.S. Have not worked. And I think the administration needs to respond forcefully and do so in a way that leaves the Iranians pausing and saying, maybe this strategy isn't worth it. Maybe the juice just isn't worth the squeeze on poking the Americans.
I think we're still trying to understand what that actually looks like. And Elliot, I wonder from your perspective whether you think this administration will continue to draw a distinction, a firm line between Iran and Iran-backed groups. When you say Iran is responsible, does the White House see it in quite the same way when they start to formulate how to strike back?
I think they do. I think most administration officials or anyone who's worked in the national security space for a while is pretty clear-eyed about how they see the Iranians. I think probably where there's more disagreement is, what is the button that you're going to push that's going to get you the response you want. So I'm sure, those are the conversations that are happening inside the White House right now. I think anyone who tells you that this is simple or easy and they absolutely know what the right response is, probably not being totally honest with you. It's a very, very complicated decision. And we have to hope that our leaders are going to do the best to formulate a response that gets us that result. But these are the tough ones that they're dealing with right now.
This is certainly a tough one. Elliot, thanks for being with us this morning. Elliot Ackerman there, US Marine Corps veteran. Phil Camprelli of JP Morgan Asset Management still with us. Phil, this is the question that we've been asking now for months. What's crude doing in the 70s, given the conversation we just had?
So I think from the standpoint of just U.S. Independence, right, we're much less reliant than we have been in prior decades. I think that's pretty clear, and we've seen that in prior conflicts. John, there's also an element of outside of geopolitics, what does global growth look like? What is the demand for commodities coming from places like China that are worried about more of their property market than anything else, right? So I think crude in the 70s is just one other story that's adding to the soft landing. The biggest tax on an American consumer is when gas prices spike. Yeah. And gas prices right now are basically some of the most attractive prices that we've seen in a long time.
Everything you just said, does that make you hesitant to take exposure to energy stocks when you're thinking about where to take equity exposure right now?
Yeah, we wouldn't be allocated to energy stocks. That's, I think, similar to what the emerging market question is. And if we get a position like we did in 2017, where we saw coordinated global growth and demand for energy, sure. but that's not what we're looking at.
It's not where we are right now, that's for sure. Phil, it's good to see you. Thanks for catching up. Phil Camporetti there of JP Morgan Asset Management. Coming up next, Stephanie Roth of Wolfe Research counting us down to this week's Fed decision and Friday's payrolls report from New York. This is Bloomberg. 60 minutes away from the opening bell in New York City. Equity futures right now. This session lows, we're down about 0.2%. Here's a snapshot of the market. Equities down. Equity futures on the Nasdaq off by 0.2. The Russell, the small caps lower by, let's call it, 0.5%. In the bond market, 2-year, 10-year, 30-year. Just to slice up the Treasury market for you. Unchanged on a 10-year, 4.0681% on a 10-year. Unchanged on a 2-year, 431.59. Nothing unchanged about this market yesterday, Bramo. All about the Treasury borrowing less than we thought they'd have to borrow.
Which is kind of what happened that turbocharged the rally back in November. The Treasury Department came out and said that they expect to borrow $760 billion in net borrowings, I should note, in the first quarter. So here's the question, going forward, is this their tactic? Is this because tax receipts are coming in, or is it because you expect that rates are going to be lower later? So you might as well sell more later and wait and get a discount then and kind of like bide your time now.
Is this going to be an election issue or not?
The Treasury borrowing and sort of the deficit?
Yeah.
Well, everyone talks about it, but it seems like voters are just sort of like, yeah, but we want our entitlements too.
Also, it's an election issue against who? It's Biden versus Trump. They both added trillions to the deficit. So neither of them really has a leg to stand on.
I like that we see through that now. Like, no one buys that anymore. Anyone who gets into power, you're a hawk, a deficit hawk, until you get into the White House and you're no longer a deficit hawk.
Even the hawks right now are not talking about true cuts that could actually make a material difference to the deficit. That just isn't happening, except for a bipartisan committee that's basically been ostracized by the mainstream conversation. But here's the question. At what point are people going to care? When you actually have to pay more, when you actually are seeing it in your borrowing costs, and that doesn't seem to be the case right now.
They actually have to go after Medicare and Social Security, and no politician is going to go on television and talk about it. Nikki Haley did talk about what Joe and I.
She tried to whisper it.
And she talked about 65 as being way too young, and then she got hammered on it. Trump ran ads against this specifically. It's a losing issue.
The boomers in the driving seat, AMH. More on that a little bit later. No, under surveillance this morning. Iran urging diplomacy as pressure mounts on President Biden to respond to the attack on U.S. troops in Jordan. Iran's foreign minister denying his country's involvement and saying the solution to the current crisis is political. The administration continues to blame Iran-backed militias for the drone strike and has yet to outline what a response would be. Annmarie, they've been somewhat cagey over the last 24 hours.
Well, of course, they're not going to come out and signal to Iran exactly what they're going to go after. But I thought Elliot Ackerman did a really good job in explaining what it could be. Do we go after, say, Iranian proxy missile depots, or do you go for something much harsher, which is what the Trump administration did, which is actual personnel of Iranian officials, say, in Iraq or Syria? That would send a massive message to Tehran.
Hasn't impacted markets at all this week. We were down yesterday, down again this morning on crude by more than 1%. Brent 81.38. WTI 75.90 after a 6% rally just last week on crude. This will move markets a little bit later. Big tech earnings kicking off. Microsoft, Google reporting later today. Apple, Meta, Amazon due Thursday. 5 names, combined market value exceeding $10 billion. Chipmaker AMD also set to report this afternoon, looking to compete with Nvidia in the race, Bramo, to power artificial intelligence.
Given just how much of the market capitalization this is, a real question here going forward about how potentially vulnerable the market is to any downside surprise. Again, I'm struck by what everyone who we've talked to says, which is there will not be a downside surprise, so stop even trying to game that out. This has been the source of strength, and it continues to consolidate revenues with companies plowing a lot of investments, not only into artificial intelligence, but also potentially reviving some of the cloud investments as well.
And as you said earlier, that number's 10 trillion, not 10 billion. Although 10 trillion is just sort of this unthinkable number a couple of years ago.
It's fictional,
Amazing.
Kind of, so at a certain point, billion, trillion, quadrillion. But this, to me, the size of these is really the reason why people are so focused.
I'll give you another fictional number, but apparently it's real. A ticket to this year's Super Bowl in Vegas will cost an average of $9,800, the highest price on record. Add on another $1,000 for a night at a hotel in the area, plus food. And you're looking at a pretty pricey weekend. No word on Taylor Swift's attendance to cheer on her boyfriend and the Kansas City Chiefs tight end Travis Kelce against the San Francisco 49ers. Are we blaming Swift for this? or the team's just good and it's in Vegas and that's why it costs so much?
I feel like a small piece of you is dying as we talk about this, but I do think that there is this feeling that this is Swiftian inflation, and I'm sure that there will be
apparently, according to Apex Marketing Group, she's added the equivalent brand value of $331 million for the Chiefs. That's unbelievable.
Isn't that amazing? I think there is more interest, genuinely. I put it on at the weekend, I don't care.
One of my best friends doesn't care about the NFL. She brought me to a Jets game once only because her dad had access to this beautiful suite. We ate sushi, didn't see a single ball thrown. And now she's finding Kansas City Chief bars just because she's a Taylor Swift fan.
Okay. Not to make this too much of a stretch, but isn't this sort of the playbook for a lot of content providers, is that you need a story and you need some sort of drama and then you can charge 70% more for tickets? I'm just saying.
David Beckham, Posh Spice.
Okay.
Oh, it's that all over again?
Well, I think so.
Except I think David Beckham was more known than Travis Kelce.
Maybe globally, but not within the United States.
Didn't we already do that?
No, I reckon actually maybe David Beckham is more well known in America than Travis Kelce before this relationship.
Now,
yes,
but not when he started dating Victoria Beckham.
But Taylor Swift kind of supersedes that.
Okay, I mean, this is not something we should spend time on. This is.
Oh, we just did.
The Fed. First decision of the year, 2 p.m. Eastern tomorrow. Stephanie Roth wondering what she's doing here. Chief economist of Wolfe Research expecting it to be a, quote, snooze. She's calling it for the Fed to begin cutting in the second quarter and continue at a quarterly cadence until troughing at 2.5 to 2.75%. She anticipates the tapering of QT will begin in June and finish by year end. Stephanie joins us now to talk about that snooze. Stephanie, good morning to you.
Good morning.
How boring is tomorrow going to be? How non-committal will Chairman Powell be?
I think tomorrow will be kind of boring. He's going to be data dependent. They have 2 more inflation prints before the March meeting. I still don't think they're actually going to be cutting in March. They're not really in a rush. The data have been pretty good. They'll be talking about the Congress talking about QT, and that will probably kick off in June. The bigger news for the week is probably going to be payrolls.
You think payrolls on Friday? What are you expecting? Because we've heard some people say it's weaker already. And not the headline number. I'm talking about where the jobs gains are coming from. The breadth is just narrower. Is that important to you?
I think that's the one blemish of the U.S. economy at this point. That's the one piece of data that actually gets me kind of a little bit worried at night. Not my base case that this is worrying. I think breadth will improve. But if you look, about 77% of job gains have been driven by healthcare, government, and social assistance. That's not the sign of a healthy labor market, but I do think that the tide will turn in this part of the year. Financial conditions have eased.
Yeah, but let's push that forward. This idea of the rolling recession moving to a rolling recovery or a rolling boom, right? We were hearing about the boom in the Midwest and some of the industrial stocks. Do you see some of the recovery and the strength coming from a couple of key sectors and leaving some of them behind?
Totally. We've seen this rolling recession, which is one reason why the U.S. economy has been able to be resilient thus far. And now we're going to get that kind of in reverse. And now you'll start to see some of the cyclical sectors start to rebound. Housing is kind of one of the most obvious, but you should get the more cyclical areas that are tied to interest rates should see a little bit of relief here.
Redfin put out this statistic, and I thought that it was fascinating, that home buyers on a $3,000 monthly budget have gained nearly $40,000 in purchasing power since mortgage rates peaked last fall. That's the equivalent of just what kind of shift there has been, given that we have seen rates, benchmark borrowing costs come down. How much further do they have to come down before you start to see real strength in certain sectors and certain consumer cyclicals, and even more strength in the home building sector?
I think if mortgage rates fall by another 50 basis points or so, I think then you'll start to feel even more of that impetus. We're already starting to see signs of it. You started to see mortgage apps look a little bit better. You're starting to see signs that the housing market is coming back to life, even with the rally that we've seen so far. And if we just get a little bit more of that, it could really do fairly well.
There seems to be an obsession on Wall Street with real rates and this idea of passive tightening, that as inflation starts to come down and the Fed keeps nominal rates on hold, real rates go higher and monetary policy gets tighter. Alan Ruskin of Deutsche Bank, I think, put out a really interesting piece yesterday. I'd love your reaction to it. He said there's also a stimulatory impact from lower inflation. As inflation slides, it, 1, boosts real disposable income, 2, adds to the growth of real money balances, and 3, supports real wealth if asset inflation is turning ahead or running ahead of goods and services inflation. So which effects should the Fed be emphasizing, and what is the impact on markets? How would you respond to that?
I think the most important one is on the inflation coming down. You saw consumer confidence just coming out recently. I mean, people are really starting to feel better, and they're starting to at least acknowledge that inflation is coming down. So I think that's probably the most important part is real incomes are going to really start feeling better, and they already have. I mean, I think the risk to this year is that actually growth could be better than people think, rather than the opposite.
So they shouldn't be concerned about real rates going up and this passive tightening that the likes of Matt Lazzetti and Deutsche Bank have talked about.
I think it would become a problem if the Fed wasn't willing to pivot, but clearly they are. So the Fed will be cutting this year, and that will offset a lot of that impact.
So where does inflation fall into this? Can we continue to get disinflation if everyone's feeling a lot better and has more real money to spend?
So far, inflation has proven, you mentioned this the last time I was on here, is inflation has proven to be somewhat transitory. And you know, nobody likes that word, but that's kind of, it's just taken longer than anybody thought. But now you've had a really strong year for economic growth last year, and inflation is now back down to 2%. There is the risk that inflation could pick back up, but so far it's proven that a strong economy doesn't necessarily mean that inflation can't continue to sort of come back down.
We are seeing some serious inflation in Super Bowl tickets, and I'm wondering whether you're expecting that to go into some of the reports. No, seriously, we were hearing about...
I think Stephanie's nervous about where this is going.
No, but like we were
going into Taylor Swift questions.
Hold on a second. No, because we were talking about the Barbenheimer effect, and we were talking about, you know, the Swift concerts and Beyonce concerts. Are we going to start seeing this in some of the economic reports?
You know, last year we didn't really see the impact of Taylor Swift on inflation, so I think we'll be okay. And by the way, I think that Vegas probably is a big reason why some of the ticket prices are so high.
You agree it's Vegas, right? Vegas is just nuts.
Why?
It's insane. I've got no idea why. People seem to love going there. $10,000 for a ticket, $1,000 for a night,
weekend.
Food, gambling. Insane.
It didn't used to be. It used to be that the hotel hotel prices were lower, and then people would just gamble a lot. And I think that they changed that kind of with some.
And as you said about Usher, he's been playing in Vegas for a while now, right?
Yeah, he's there. So if you actually care to go see him, then just go to an Usher concert in Vegas. Save your money. You can go to how many Usher concerts?
We're here to save you thousands,
6 or
Bramo,
7.
just in case you really wanted to see Usher play.
I appreciate that.
At the Super Bowl. Is anyone going to the Super Bowl just to watch Usher?
Literally, I mean, honestly, I keep going back to this. My kids don't know Usher. And what are you surprised? I mean, honestly, they said, "Who's Usher? Is it ushering a concert?" And I was like, "No, it's the singer Usher."
Kind of surprised.
They're not the target audience.
But that's exactly it.
It's
a good point.
Our wallets that they're after, and that's what the advertising is about. And it's like when Dre did the halftime at the Super Bowl, and we all felt really old, right? Because we were the target audience now.
We knew all the words, but you know, our nephews or kids did not.
Precisely. Stephanie, it's good to see you.
Good to see you too.
Stephanie Roth of Wolfe Research, thank you very much. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hakez.
Hi, John. More signs of waning demand for EVs, with Volkswagen pushing back plans to seek outside investment for its battery unit. Europe's biggest car maker is also facing doubts it can make its own batteries at scale, according to Bloomberg sources. Renault also scrapped plans to publicly list its EV business this week. JetBlue reporting a smaller than expected fourth quarter loss, while its revenue topped forecasts. The carrier citing continued strong demand during peak periods, likely fueled by holiday travel. JetBlue reporting results as it undergoes a C-suite shakeup. Chief Operating Officer Joanna Garrity taking the reins as CEO this week. Meanwhile, its possible merger with Spirit Airlines becoming increasingly unlikely. Both companies appealed a ruling blocking the deal. The PGA Tour is reportedly close to receiving an historic investment from billionaire sports team owners. Steve Cohen and Mark Lassery are among the group of investors set to inject about $3 billion into the league. The deal may not initially include Saudi-backed Live Golf, with talks still fluid on how to include the rival organization. That's your Bloomberg Brief. John?
Yahara, thank you. Coming up next on the program, Microsoft's massive expectations.
The biggest hardware business we happen to have is our cloud. We stream from the cloud.
That's coming up next. You're watching Bloomberg Surveillance with numbers from Microsoft and Alphabet after the closing bell. Equity futures on the S&P 500 negative here by 0.25%. The cash open about 47 minutes away. Breaking news, the Usher residency is over. AMH in a commercial break. getting the updates for us. Is that right?
Yeah, it seems that he broke down during his final Las Vegas residency, December 3rd.
Okay.
That's when Entertainment
Which
Weekly
is why the
posted
tickets
that.
cost so much, because if you missed the tour, of course. This
Exactly.
makes perfect sense now. Equity futures on the S&P 500 negative here by 0.2%. Yields unchanged, 4.0681% on a 10-year. In about 44 minutes, an opening bell. Looking ahead to tech. Before we get to tech, we need to talk about earnings out already this morning from GM and UPS. The outlook for UPS, not great. The outlook for GM, better than expected. GM up by 7%. Lisa, UPS is down, let's call it 5.6%.
And GM really highlighting the theme that we seem to be hearing all through this morning, which is incredible bullishness on the United States. I mean, honestly, one person after another coming out and just talking about how they see this continuing. GM seeing strength in North America. This is not about necessarily global strength, and this is about strength in selling their bread and butter, which is gas-powered trucks. And that seems to be something that people want to buy again at a time when maybe you've got pent-up demand, rates are coming down, and the economy is chugging along.
I'm looking forward to catching up with Mary Barra later. What would you like to know from the chairman CEO of General Motors?
What can go wrong, how worried they are about Chinese competition, and what they see in terms of the outlook for EVs, for electric vehicle production. Do they expect to ratchet it back down more? Do they expect to do hybrids? Hasn't been the case so far. How are they sort of positioning for that?
On this call, she's talking about it's true that there's uncertainty in the EV market because they haven't seen that growth in demand. But she's still saying that they're going to sell about 250,000 EVs this year. The Stellantis CEO says he's pulling money back on EVs until he figures out who wins the U.S. election. So I would love you to ask Mary Barra that.
Wow. You heard what Elon Musk had to say from Tesla last week. That quote that you pulled, I think it's really important too, that we'll get demolished here in the United States unless we have big tariffs to stop Chinese competition.
At the same time, in order to get more people involved in the electric vehicle market, prices have to come down. Something's got to give, right? And at a certain point, you can imagine tariffs are going to continue. But what do you do with the innovation and, frankly, the supply chain, lithium, here in the United States?
Check out this headline from UPS to cut 12,000 positions for a $1 billion cost reduction.
Wow. I mean, that's a lot of positions after some of the union negotiations and some of the higher wages that they're paying. There's a real question here after they outperformed. Is this a more macro issue, or is this an Amazon competition issue? The fact that people are perhaps shipping in a slightly different way, John?
They've got two very different stories to tell, both GM and UPS this morning. UPS is down more than 6% in pre-market trading. Under surveillance this morning, Microsoft has some massive expectations.
The biggest hardware business we happen to have is our cloud. We stream from the cloud. Just as maybe in the past we were known as an Office company or a Windows company or a cloud company, I think going forward we will be. We have a Copilot. We have a Copilot stack in Azure.
Here's the latest this morning. The tech giant reporting after the bell, expected to see a jump in revenue boosted by growth in demand for cloud services and personal computers. Derek Wood, software analyst at TD Cowen, writing this. Microsoft appears well positioned in key secular growth markets, particularly public cloud and its Azure platform, which we expect to be the company's main growth driver. Digital transformation trends should continue to benefit every facet of Microsoft's commercial cloud. Derek, I'm pleased to say, joins us right now for more. Derek, the tailwinds for cloud, can we start there? How strong and powerful are they into 2024?
Well, certainly that is the big focus, the Azure growth. That is their largest business today, about a $50 billion annualized revenue business. We're looking for 27% growth. That's also the highest growth rate of any of their products. What we got from last quarter, coming out of the September quarter, was that cloud optimization headwinds really seem to be past us, and core IT spend is coming back, and then there's an incremental tailwind coming from AI. AI is expected to produce over 3% of the growth, or about $2 billion in annualized revenue on Azure this upcoming quarter. So we're all eager to hear how things are going, what the outlook's going to be going into the March quarter, how they're feeling about budget loosening, over the next 12 months. And really a continued improvement in the Azure growth rate. In September, Azure growth accelerated 1 point. We think there could be some incremental upside in the December quarter as well, and we could see a path for continued acceleration.
Derek, on the cloud business itself, is that the pie getting bigger? Are they getting a bigger share of the pie at the same time?
So for some comparison, AWS is about a $95 billion run rate. GCP out of Google is about a $35 billion run rate. and Azure is 70 billion right now, and their growth rate is by far the highest of those three. So they are certainly gaining share. That has been the case for a while, and of course, cloud spend is taking over more and more of IT. There's still a lot of workloads that are on premise that need to move to the cloud, especially in the financial services vertical. So I think it's a bit of both.
How much do you expect, Derek, monetization of the whole AI craze that we hear from absolutely everyone we're talking to? How much is that going to be important in these particular earnings?
Well, so I think the first order of monetization is coming through Azure. That's really the platform where companies are coming to build large language models, develop new applications, pay Microsoft for the infrastructure to do that. And again, we said there's probably going to be about $2 billion in incremental annual spend on Azure. The next line is going to be around the Office business and the new Copilots they've released. Copilots came out generally available in November, so we're really only going to have a very small part of the quarter where we're going to see incremental revenue. Commentary looking forward is going to be important, but I do think the Copilots will take time. I think legal has to go through and really analyze the risks of using some of these models. There's just going to be testing by different work groups. I don't think there's going to be some mad rush to see big adoption for Copilot, but I think gradually over the next 12 to 18 months, we'll see adoption rates build and build.
Derek, how high is the bar for Google, given that they don't have the same kind of market share for their cloud offering that Microsoft does or AWS of Amazon does, and the fact that some people suggest that the Google search engine is the most disruptible of all technologies, given some of the ChatGPT technology?
Right. Well, I don't cover Google. That's by our internet analyst. But last quarter, they did see big deceleration in their cloud business. So I think this quarter, people are going to be looking at what the trend rate is from here. But they did drop below Azure growth rate for the first time in the September quarter, and that put Microsoft and Azure at the top. In terms of what Microsoft is doing with Bing and the ability to bring OpenAI and ChatGPT technology through the search engine, I don't think we've seen a lot of incremental share gains from Microsoft. I think it's really tough to break the Google domination in search. We'll be looking for some evidence of that, but the expectations for Microsoft Bing to gain a lot of share from Google is pretty minimal today.
Are you curious about what they say about OpenAI and how much that partnership is going to kind of fuel what comes next?
Yeah, I mean, there's been a lot of questions. I mean, the New York Times bringing litigation to OpenAI and Microsoft. There's some regulatory reviews on the partnership between those vendors and a few others in cloud and AI. I doubt that's going to get brought up much on the conference call. I think we'll just see more press releases, down the road. But it'll be interesting if Microsoft feels like they need to, strike some other partnerships with other content providers to avoid, litigation that's coming from the likes of New York Times. That could be something to touch on, but it hasn't been that topical in the investor community.
Interesting. Derek, we've got to leave it there. Thanks for being with us, sir. Appreciate the preview. Derek Wood there of TD Cowen on Microsoft and Alphabet reporting after the bow. Then on to Thursday, we'll hear from Amazon, Meta and Apple. That is $10 trillion across 5 names. More than $10 trillion in market cap. I've been saying billion all morning, just not used to saying trillion.
Billion,
but,
trillion.
what's that between friends,
exactly?
Right?
I mean, at a certain
trillion.
point.
This headline right here from GM, I think is really, really interesting. Mary Barra, just speaking on the earnings call, said GM will develop plug-in hybrids to cut emissions. So we've got the sequencing here. You go from the internal combustion engine to full EV. Is there something in between in the interim, which is ultimately going to be hybrids? And we've seen the demand for hybrids start to take off. We've seen some companies, Ford, really leaning that direction. GM has been hesitant to do so. That headline, to me, is something we can talk about with Mary Barra a little bit later this morning.
Very much so, given the fact that if people kind of get an upper hand, it's also a way to distinguish the U.S. market from China in terms of the supply chains, as well as some of the advantages with respect to the technology.
Also, the dealers who are dealing with these customers sitting on her advisory board have been pushing executives to offer a hybrid. And then the Wall Street Journal reported this, and then she comes out and says, we're going to do it.
This goes back to something we've talked about over the last few weeks. It's not a reality check for the ultimate destination yet, but it certainly is when it comes to the pace at which we get to that ultimate destination. We've got to slow down. That seems to be the warning coming from many different places.
And this headline suggests not only slow down, but maybe even shift gears a little bit about how to wean people into this area.
Didn't John Kerry himself say it's not a light switch?
He did say that. He said that more than 13 million barrels a day of crude production was necessary, I think, as well. Coming up tomorrow, don't miss this, Bruce Kasman of JP Morgan, Sebastian Page of T. Rowe Price, Wei Lee of BlackRock, and former Fed economist Claudia Sahm. All of that coming up on Fed Decision Day.